of group account, and in this session I want us to look on another concept of group accounts, and the concept is changes in group structure or disposal of interest. So when we talk about the disposal of interest, or basically changes in group structure, this whereby the parent company will sell all the shares held in a subsidiary, or basically sell part of the shares and retain some of the shares held in such what? A subsidiary. So therefore, what we're going to do here is we're going to look on how to prepare the group account whenever there is changes in the group structure, or basically we have now the disposal of what? Of interest. But before we even do that, we can have an introduction to this, and we say that changes in group structure occurs when the parent company sells the whole or part of shares, whole or part of shareholding in the subsidiary company, subsidiary company. So basically that's what we refer as the disposal of interest. So the parent company here will sell some of the shares, or basically all the shares which are held in what? Which are held in a subsidiary company. Now generally the disposal of interest can be broadly classified into two main categories. First of all, we have what we refer as a full disposal. A full disposal is whereby the parent company sells all the shares which are held in a subsidiary. That is a full disposal. But on the other hand, we have a partial disposal whereby the parent company sells some of the shares held in a subsidiary and retain some of the shares. So therefore here we can talk of types of disposal of interest, types of disposal of interest. So when we say there are two types of this, we say disposal of interest can either be, number one, we have the full disposal, and then we have the partial disposal. Disposal. But in accordance with the International Financial Reporting Standard number 3, a disposal of interest basically occurs when the parent company loses control. So mean that once the parent company sells some of the shares which are held in a subsidiary company, and the parent company now loses control. So mean that the shares which will be held by the parent company in the subsidiary falls below 51%. So actually from 50% to 0. That is the time the disposal is deemed to have occurred in accordance with IFRS 3, in which case then the parent company is required to determine something called the gain or loss on disposal. So therefore the gain or loss on disposal basically is determined when the parent company loses control. So therefore you can say according to IFRS 3, International Financial Reporting Standard number 3, disposal of interest occurs when the parent company loses control. The parent company loses control. So basically what that means is that the shares now which are retained by the parent company in the subsidiary, or basically the parent company will sell some of the shares and retain shares which are less than 51%. So that is the time the disposal take place. And in such a case, then we are saying the parent company should proceed and determine the gain or the loss on disposal. What is important, therefore, to note as far as that point is concerned is that if the parent company has retained a control, when talk about retaining a control, this whereby we can be told A Limited, which held 80% of the ordinary shares issued by B, the parent company, we can be told, like sold like 20% of the shares. 20% of the shares. What does that mean? It means that the parent company has retained 60% of the shares in what? In B. In such a case, you can see the parent company still having a control, because we said a company or an investor company will have a control of the investee, whereby the shares held by the investor company, the investee company, lies between 51% to 100%. So, but you're saying disposal in accordance with IFRS 3 occurs anytime the parent company loses control. It sells some of the shares here and retain shares which are now less than 51%, from 50% to 0. In which case we are saying a gain or a loss on disposal should be what? Should be determined. And therefore, you can say when disposal of interest occurs, that is when the parent company loses control, control, a gain or loss on disposal should be computed or should be determined, we can say should be determined as follows. So how do we compute that particular gain or loss on disposal of interest? So gain or loss on disposal of interest. So to determine this gain or loss on disposal of interest, number one, we take the fair value of purchase consideration received. So when the parent company sold some of the shares, or basically all the shares in a subsidiary, how much amount was received by the parent company? So that is now what referred as the fair value of purchase consideration received. To this we add the fair value of investment which has been retained. When talk about the fair value of the investment which has been retained, so this basically applies in case of a partial disposal, whereby the parent company has not sold all the shares in a subsidiary. If, for example, the A Limited, which is the parent, which initially had acquired 80% shareholding in B, which is a subsidiary, if, for example, the parent company sells like half of these shares, sells 40% of the shares held here, it means that the parent company has retained a shareholding which is equal to 40%. So at the date the disposal took place, the remaining investment will have to be revalued at its fair value, and always that figure will be provided to you. That's what we refer to as the fair value of the investment retained. So after adding those two figures, we come here and we less, number one, the fair value of net assets, held at date of disposal, So the fair value of the net asset held at the date of disposal, and then to this we also add the parent company unimpaired goodwill. And after deducting those two figures, we can get a positive figure here. If a positive figure, that is a gain, but if a negative figure, this is a loss on disposal a loss on disposal, a loss on disposal. Yes, so this is basically how the gain or loss on disposal is determined anytime the parent company has lost the control. The parent company sells some of the shares held in a subsidiary, and therefore it retains shares which are less than 51%, from 50% to 0. Always in such a case we compute the gain or loss on what? The gain or loss on disposal. So then next we can proceed and look on how we prepare the consolidated financial statement anytime we have changes in the group structure. So let's look on the preparation of group accounts. So in this case, we're going to look on how we prepare the group accounts at different types of disposal. So remember, you have said that disposal of interest can be broadly classified into two: partial disposal and the full what? Disposal. Let's start with the full disposal. The full disposal. A full disposal generally is whereby the parent company sells all the shares held in a subsidiary. Sells all the shares held in a subsidiary. Maybe first of all, you can say that this is a whole what? Disposal, or basically a whole sale of shares in a subsidiary. So a wholesale of shares in a subsidiary company, and this one is basically governed by. This one is governed by IFRS 5. So basically, in terms of how the parent company should treat that particular subsidiary which has been free disposed, that should be accounted for in accordance with IFRS 5, meaning that that subsidiary now will be termed, or basically will be referred to as a discontinued operation. A discontinued operation, assuming we are told A Limited had acquired 80% shareholding in B Limited, and the parent company sells all these shares. So if that is the case, then this particular subsidiary is a discontinued operation, and should be accounted for in accordance with what? In accordance with IFRS 5. So what IFRS 5 requires is that the parent company should, number one, determine the gain or loss on disposal, and number two, the parent company should determine the gain or loss reported by that discontinued operation, and that one should be recognized, or those two items, the gain or loss on disposal of interest, the gain, the profit or loss from the discontinued operation, they should be recognized as separate items in the consolidated income statement. So therefore, we can say in this case, the parent entity, or basically company, should determine, or in other terms, determine, number one, the gain or loss on disposal, the gain or loss on disposal of interest, and number two, the profit or loss from discontinued operation. We can abbreviate this as DO, from discontinued operation. And you are saying that these two items, that is the gain or loss on disposal and the profit or loss from discontinued operation, they should be recognized. This should be recognized as separate line items in consolidated statement of profit or loss should be recognized as separate line items in the consolidated statement of profit or loss. Let's maybe from our group structure here, we introduce another company here, that is C Limited. We also assume that the parent company had a shareholding of 75%. So, and also we are told that the parent company, that is A, had 80% shareholding in B Limited, but we are told during the current financial year, the parent company sold all the shares held in B. So we have said B is a discontinued operation. So therefore, when A Limited is preparing the consolidated income statement, the consolidated income statement or the consolidated statement of profit or loss. So the parent company should first of all determine the profit or loss from the continuing operations. So the continuing operations will be the parent company and the NC, because you have said this one is a discontinued operation. So therefore, the parent company should determine what the profit or the loss from continuing operations. Continuing operations include A and C. And for the parent company to do that, basically, in this case, we take the revenue of this, that is A, plus the revenue of C. And then we also take the expenses, including the cost of sales of A plus that of C, We less that now from the revenue. We get, whatever you get here will be the profit or loss from continuing operations. Continuing operations. And then we are saying that these two items here should be added to the profit or loss from the continuing operations. So then we have the discontinued operations. Discontinued operation, basically, you have said, is this subsidiary which has been disposed. So two items will be included here: the gain or loss on disposal of interest. And you have to recall that this one is computed using that particular approach there, or that particular format there. And then we also have the profit or loss from discontinued operations. So how do we determine this profit or loss from discontinued operations? So we take the revenue of this company. For example, the parent company sold the shares held in B Limited, for example, 6 months from the start of the current financial year. So in that case, you take the revenue of B for the first 6 months and also its expenses for the first 6 months, and then determine the profit or even the loss which was reported by that subsidiary B, which was fully disposed. You'll get the profit or loss from the discontinued operation. So if it's a profit, you add; if it's a loss, we do what? We less here. We less. And then we add that now to the profit or loss from the continuing operations, and then we get the profit for the year. The profit for the year. So that's basically how we deal with what you refer as a full disposal. And basically, remember, these applies in preparation of a consolidated statement of profit or loss. Consolidated statement of profit or loss. So basically, when now preparing the consolidated statement of financial position, at the end of the year, the parent company will have fully disposed its shares in this subsidiary. So the parent company will not be having any control. Equally, there will be no NCI. So therefore, we can say that when preparing this consolidated statement of financial position, we can say there will be no NCI, or basically we can say assets and liabilities of subsidiary fully disposed are not included in consolidated statement of financial position. So the assets and liabilities of that subsidiary will not be included in the consolidated statement of financial position. And equally, as far as that subsidiary is concerned, there will be no NCI. The minority shareholders will not be entitled to share the net asset of that subsidiary as at the end of what? Of there. That's basically how we deal with the what you refer as a full disposal. Then from there we have the other type of disposal. That type of disposal. Recall in our case here we have said that we have two types of disposal: the full disposal and the partial disposal. The partial disposal. Partial disposal. Now here we have different types of partial disposal. Actually, we can say we have different scenarios of partial disposal. Number one, or number A, we have what we refer as a disposal of a company which was initially a subsidiary and which still remains a subsidiary. Which still remain what? A subsidiary. A subsidiary company to a subsidiary. So when talk about a subsidiary to a subsidiary, this whereby we can be told the parent company had like 80% shareholding in B Limited, and the parent company, for example, sold 20% of the shares. So if it sold 20% of the shares, then it means that the parent company here retained 60%. Retained 60%. So therefore, you can see B Limited still remain what? Remain a subsidiary. So when it comes to preparing a consolidated income statement, what you do, you take the revenue and expenses of that subsidiary, you add to that of the parent. Actually, that disposal do not have any effect as far as the preparation of the consolidated statement of profit or loss is concerned. On the other hand, when preparing the consolidated statement of financial position, because this company is still a subsidiary at the end of the year, you take its assets and liabilities, you add to those of the parent. Actually, this particular type of partial disposal do not have any effect as far as the preparation of the group account is concerned. It's also important to note that here, because the parent company is not losing control, no gain or loss on disposal of interest is computed. This one is not computed because you have said we only compute that one anytime the parent company loses what? Control. So we can say no gain or loss on disposal of interest. On disposal of interest. Disposal of interest. So that is it about that scenario of partial disposal. So the other type of partial disposal, part B, is a disposal which makes a company which was initially a subsidiary to be an associate or a joint arrangement. So first of all, you have to recall from what you have discussed in our previous sessions that investment in associate, investment in joint arrangement should be accounted for in the same way using the equity method. That is something, first of all, you have to recall, and that's why you can see here we are talking of associate or the joint arrangement at one point. So this whereby we assume that the current financial year was ending on 31st of December 2023. That is the date of consolidation when the group accounts are supposed to be prepared, meaning that the year started on 1st of January 2023. We may be told that the parent company initially had acquired like 80% of the shares, 80% of the shares, like maybe A Limited had initially acquired 80% shareholding in B Limited some time back, but during the current financial year, maybe on 1st of July 2023, the parent company sold or disposed 40% or half of these shares. So mean that the parent company sold 40, and that means that the parent company then retained 40%. Retained 40%. So if it retained 40%, then it means that this company, which was initially a subsidiary, then becomes what? An associate. Becomes an associate. And therefore, in the first 6 months, the parent company, you can see, had 80% shareholding, meaning that this company was therefore a subsidiary. And then after selling half, the parent company retained 40%, meaning that in the last 6 months, that company was what? Was an associate. Was an associate. So how do we go about in this case, or how do we prepare the group account in such type of a partial disposal? Number one, when preparing the consolidated statement of profit or loss, in preparing the consolidated statement of profit or loss, number one, we have to compute the gain or loss on disposal. We have to compute the gain or loss on disposal of interest, of which this particular gain, if it's a gain, it is recognized as an in the income statement as an income. If it is a loss, it is recognized as an expense. Number two, we then consolidate the results of the subsidiary company up to date of disposal. Up to date of disposal. Like in this case, in preparing the consolidated income statement, we're going to take into account the revenue and expenses of B for the first 6 months when it was a subsidiary. And then in the last 6 months, because it was an associate, you have to recall that we don't include the revenue and expenses of associate in the consolidated income statement. So that's why we are saying consolidate it results up to the date of disposal, and thereafter include group share of its profit after tax, and that is in accordance with equity method. That is in accordance with IS 28, because as far as the associate is concerned, we include, or what we include in the consolidated income statement is the group share or the parent company share of its profit after tax. So mean that you'll take the profit after tax of this company here, which is always given in its income statement, multiply that with 6 all over 12, so that you get now the profit after tax for the last 6 months when it was an associate, and then multiply that with the parent company shareholding in B, which is 40%. So that's basically how we prepare that. And then how do we prepare the consolidated statement of financial position? Consolidated statement of financial position. So in preparing the consolidated statement of financial position, our interest is basically the status of this company at the end of the year. So what will be the status of the investee company at the end of the year? At the end of the year, the investee company, that is B, will be an associate, and therefore in accordance with the equity method, what we include in the consolidated statement of financial position as far as the associate is concerned is something called the investment in associate. We don't include, or we don't combine, the asset and liabilities of the parent, those of the associate, in preparing the consolidated statement of financial position. So therefore, in preparing this, we say compute the investment in associate, or joint arrangement, and included in consolidated statement of financial position as a non-current asset. So in that case, you compute, or we compute something called the investment in associate or investment in joint arrangement, and we include that in the consolidated statement of a financial position as a non-current asset. So how do we compute this particular investment in associate or joint arrangement? So investment in associate or joint arrangement. So this one is computed using this approach here, or this format. So number one, we take the fair value of investment which has been retained, fair value of investment retained. So the investment which has been retained here is 40%, and basically we have said that in case of a partial disposal, the investment which has been retained always will have to be revalued to its fair value on the date of disposal. That figure will always be provided to you. So you'll be told that the investment which has been retained on the date of disposal had this fair value. That's what you use here. And then to this we add the group share of post-acquisition net assets. Post-acquisition net assets. And whatever you get here is now what you refer to as the investment in associate, investment in joint arrangement, and you're saying that that should be taken to the consolidated statement of financial position as one of the item of the non-current asset. Yes. So basically those are different scenarios of partial disposal, and basically how we deal with them specifically in preparing the consolidated financial statement. So basically that's what you need to know. I want us to stop at that particular point. Once we come back in our next session, I want us to look on an illustration question regarding how to prepare the group accounts, and also how to compute the gain or loss on disposal in case of disposal of interest. So see you in the next session.
Welcome to Advanced Management Accounting. My name is Mr. Mariga, and today I want us to talk about applications of learning curve model and ABC invariance analysis, which is a topic under budgetary control and control and techniques here. Now, we were tackling cost estimation and forecasting and interpretation. We talked about learning curve, where we said that learning curve here is a method of estimation that takes the general form y is equals a b plus 1 and y bar is equals ax raised to power b, where b we said is your learning curve index, which is given by log learning curve divide that by log 2. X we said is the activity level or your output, or your output. A is a time or cost of first unit of production production. Y is a cumulative total time or cost. Y bar is a cumulative average time. Time or cost. Remember, we said that when an employee gets used to doing something, they improve their what? The rate at which they produce, and that improvement rate, where they take less time or they incur less cost than the first unit they produced, is what we refer to as what? Learning curve. Is what we introduce as what? Learning curve. And we also said that NB, your learning curve rate is simply 1 minus your improvement rate. Minus your improvement what? Rate. Right, that I've given you a brief recap of that. Today we want to talk about, or I want us to introduce something on variances, where you have what? A learning curve, where you have learning curve. And we are going to do a question of November of 2020. Let's talk about November of 2020. Question 5. Question 5. November of 2020, question 5 is a question we will tackle today, where they're saying High-Tech Limited intends to launch a locally manufactured printer in the coming month of December 2020. The Research and Development Department of the company has provided the following information relating to the production of the printer. You have your selling price of 17,500 per printer. Variable production cost, you have direct materials of 800 grams at 7,500 per kg. Direct labor of 75 minutes at 3,000 shillings per hour. Variable overheads of 60% of direct labor hour. Then you have your contribution per printer. Production of the printer is scheduled to commence on 1st of December 2020. The company plans to produce and sell 3,000 printers per month. A direct material loss of 10% is expected, with no resale value. The annual fixed cost attributable to the production of the printer is 60 million. The cost accrues evenly throughout the year. A learning curve effect of 95% is expected. Determine the standard labor cost for the month of December. So let's start with part 1. I want us to determine your standard labor costs. Now your standard labor cost will be determined by your standard what? Labor hours. You multiply by your standard labor rate per hour. Your standard labor hours, you multiply by your standard labor rate per hour. Standard labor cost is given by your standard labor hour. You multiply by your standard labor rates. Which is in shillings per hour. Okay. Your standard labor rate, they've told us currently is how much? 3,000 per hour. But we need to determine our standard labor hours. Keeping in mind that we have what? A learning curve. So let's determine our standard labor hours. So computation of standard labor hours. Computation of standard labor hours. labor hours will be given by AX B plus what? 1, where A is the time for the first unit, and the time for the first unit is 75 minutes. 75 over 60 hours, which is 1.2 what? 5, which is 1.25. Then your output that you had planned to produce is how much? 3,000 units. 3,000 who? Printers. Then B, we know, is your learning curve index, which will be your log of learning curve, and your learning curve rate is 0.95 divide by log 2, which is negative 0.074. All right. So let's then determine our labor cost, our labor hours first. You're producing 3,000 printers, rather. The time of the first unit is 1.25, but you're producing 3,000 printers. Negative 0.074 plus 1. So therefore, your total labor hours that will be used to produce the 3,000 units, keeping in mind that you have a learning curve of how many? Of 95%, is that you will use 2073 hours. 2073 hours. All right. So your labor, your standard labor costs, your standard labor cost now, you're using 2073.587056 hours. You multiply that by your standard labor rate per hour, and your standard labor rate per hour was 3,000. So therefore, your standard labor cost is there. Is that 6,220,761.167. All right, that is the first part. Then they're telling us part B to prepare a budget. A budget what? Statement. Budget profit statement. Let's start with your sales. Now this budget profit statement is what sometimes we refer to as an original budget, or a static budget. It is a budget where you consider your activity at the beginning and your cost at the beginning. So we normally say it is a budget of budgeted cost, but for budgeted activity. So when you're determining your sales, you're going to take your budgeted selling price, you multiply that by your budgeted units sold. Your budgeted selling price was 17,500. That you multiply by your budgeted units sold, which were 3,000 printers. Then you less your costs. The first cost will be the cost of direct materials, your direct material cost. And your material cost, we were using 800 grams at 7,500. But note number 3, this added and said, a direct material loss of 10% is expected with no resale what? Value. With no resale value. So the 800 grams, therefore, are at 90%. What about what? 100%. So what will you say? Going to say 800 over who? 100 kgs. You multiply that by who? By 100. Then times what? Your cost now, your cost in kgs was 7,500 to 7,500. Okay. You multiply by your printers, which are how many? 3,000. Then all these, or let me see, not all these. Then you divide that 100 by what? 90. What have you effectively done? This is what you've done. You've said that 100 is equal to what? 90. What about 800 over who? 1,000. How much will that? That is what we've done there. Why? Because they're telling us that you have a normal loss of 10% of the material. So even if you bring 100, you're going to get what? 90. And our material, how much at 90% is what? 800 grams. 800 grams, which is 800 what? Kgs. So therefore, at 100, how much do we expect there? So you expect what? 0.88. 0.88. So this 0.88 here, which is now this working, you multiply by the price per kg, then times what? 3,000 printers. That is your material cost. I hope that is very clear why we've worked at it that way. Okay, this, I think even that is what I should write here. So let me write that so that it is very, very clear. 0.88 kgs. You multiply by who? 7,500 per kg. But you had produced how many printers? 3,000. 3,000. All right, that is clear. You then add the cost of direct labor. Cost of direct labor. And because of the learning curve effect, your labor cost, we determined it. We determined it as 62, 20, 761.16 Then you did also have variable overheads. Variable overheads, where they were saying they are 60% of direct labor. So 60% of direct labor, 167. Then lastly, you had fixed what? Overheads. Or fixed costs attributable. For the whole year was 60 million, but you want only for the month of December. So you're going to take 60 million. You divide that by how many months? 12 months. You divide that by 12 months. 22. This is 20 million. This is 37. 324. 56.7. And lastly, your fixed overhead cost is 5 million. So your budgeted profits. This is 556. $556. All right. That is your budget. That is how you apply learning curve as far as variances is concerned. The next part of that question, where they're telling us to reconcile, we will do that in the next lesson, where I will introduce 3 items or 2 items. Number 1, I will introduce operating variances. I will also introduce planning what? Variances. Alright, those 2 things. But for these 2 to exist, you must have what we refer to as revised standards. You must have revised what? Standards for those 2 to be there, but we're going to talk about them in the next what? Lesson. In the next lesson. So what so far as we've been talking about is conventional variances. Conventional variances, or you simply compare standard or what? Original with actual. You're operating here, you compare your revised and your actual. This one, planning, is your standard and your actual, but we'll talk about that in the next lesson in more detail. So from me, goodbye and see you next time.
I greet you all and welcome you back to the governance and compliance audit lesson. Today, our focus is on the governance and compliance audit checklist, which is a practical tool used in the planning phase to ensure that all critical aspects of the audit are considered and addressed. So there has to be, at the planning stage, a checklist which acts as a summary of the planning process, and it provides a final check to confirm that the audit is ready for execution. In this lesson, we are going to break down the key planning phases that are covered in a checklist. And the first one is the initial consideration and scope. Initial and scope. All right. Initial consideration and scope may cover areas like the audit purpose and objectives. The checklist must answer questions like whether the audit objectives have been clearly defined. Have the audit objectives been clearly defined? The objective could be to assess compliance with the data protection laws or to evaluate board oversight and so on. Another question here at this point is the audit, if the audit has been approved by the appropriate authority. Has the audit been approved by the appropriate authority? And the appropriate authority could be the audit committee, it could be senior management. So one aspect of the checklist is the audit purpose and objectives. Then there is audit scope. Audit scope. Is the audit scope clearly defined, including the specific business units, the processes, systems that are to be audited? And have any exclusions or limitations to the scope been clearly stated and agreed upon? Has the time period to be audited been specified? So those are aspects of the audit scope which have to be covered in the checklist. So there has to be that part of the checklist which has to be ticked as the planning phase comes to an end. Then you have understanding the entity. Understanding the entity. Here questions to answer are, have we reviewed the entity's organization structure and key business processes? Another question is, have we identified the relevant industry and legal regulatory requirement? Have we gained an understanding of the entity's risk management and internal control frameworks? So that is very important. At the initial consideration scope, part of the checklist should be this, answering these three questions. Then the second part, the second aspect is our phase. So this is just phase one. Then phase two, we have risk assessment and strategy. Assessment. Now here, we are talking about the risk assessment. Risk, number one, is risk assessment. What questions should be answered here? One, have we conducted a preliminary risk assessment to identify high-risk areas of non-compliance? Number two, have we identified the inherent and control risks for the key audit areas? Then there is also the aspect of materiality. After dealing with risk assessment, there is a materiality, particularly the thresholds. Have we determined the quantity, the quantitative and the qualitative materiality thresholds for the audit, e.g., the specific legal violation is always material and so on. Then three is assurance level. Assurance levels. Have we determined the level of assurance to be provided? Is it reasonable level of assurance? Is it limited level of assurance? Is it agreed upon procedures? And does the chosen assurance level meet the expectations of the key stakeholders? That is the assurance level. Then there is, of course, the audit strategy. Audit. Now, audit strategy candidates, we have to check whether there has been an overall audit strategy. Has an overall audit strategy been developed and documented? Has the audit team been assembled with the necessary skills and expertise? Have the threats to audit been identified, and has a plan for safeguards been developed? So that's part of the second phase. Then the checklist for the third phase is the detailed planning and documentation. Detailed and documentation. Detailed planning and documentation. Here we are dealing with the subject matter and criteria, for example. Subject and criteria. Subject matter and criteria have the question to answer is, or what to check is, if there has been specific subject matter, what is being audited, that is the subject matter, and the criteria, which is the benchmark. Have these two been clearly defined? Another question is, have we prepared a governance and compliance matrix linking requirements to controls and audit procedures? 2, audit plan and program. Currently, we are discussing the checklist, which you have defined as a summary of the planning process, right? Which provides a final check to confirm that the audit is ready for execution. Now, the questions to answer in relation to audit plan and program is that 1, is the final audit plan drafted and approved? Has it been approved? Number 2, is the detailed audit program complete with specific step-by-step audit procedures? Number 3, does the program specify the evidence required for each procedure? Then, of course, we have the resource allocation. There is the aspect of resource, let me call it resource management. Resource management and logistics have the necessary resources like personnel, budget, and technology been allocated? Number 2, have we established realistic timeline with key milestones for the audit? Number 3, have we planned for access to key systems, documents, and personnel? So this is phase number 3. There has to be a checklist for subject matter and criteria, audit plan and also program, then resource management and logistics. Let's move to the 4th phase. Now, the 4th phase is the final preparations. There has to be checklist on final preparations. Having dealt with the detailed planning and documentation, there is also final preparations like issues to do with the working papers, communication. You have working papers. There is issues to do with communication. Now, the question to answer on working papers, for example, it would be, have the permanent and current files been set up? Have they been set up? The permanent file, has it been set up? The current file, has it been set up? Number 2, have all planning documents been properly documented and indexed in the working papers? And there are also questions to answer on communication. Has a kickoff meeting, for example, with the audited department been scheduled? Has a formal communication plan been established to keep the stakeholders informed throughout the audit? There could also be questions to answer on review. On the final preparation, we have the working papers, communication, and also review. And let me put it together with approval. Review and approval. All right? For example, has the entire audit plan been reviewed by senior member of the audit team? Has the final audit plan been formally approved before fieldwork begins? So those are questions that are to be answered when preparing the checklist before the audit commences. There has to be a checklist, candidates, which is a practical tool that is used in the planning phase to ensure that all the critical aspects of the audit are considered and addressed. So before getting into the fieldwork, there has to be a checklist, and all the questions that we'll be discussing are addressed so that nothing is left to chance, so that there are no omissions when the audit commences. So using such a checklist ensures that the audit team has considered all the critical elements of the planning phase, setting the stage for a thorough, effective, and well-documented audit engagement. So that's all for the governance and compliance checklist. I'll meet you in our next session where we continue to learn more on governance and compliance audit. Bye-bye.
Hello learner, welcome to Manifested e-learning platform. My name is F.A. Ngwiri, a practitioner within the financial services industry in Kenya. We are learning about asset allocation, and the specific focus is to understand what the Black-Litterman approach deals with and the Monte Carlo simulation. Now, a key component of asset allocation is to try and deal with estimation error, especially when we look at this strategic asset allocation procedure where we had this kind of approach over here. So the capital market expectations, if you recall, were on this side over here, and then we have the assets, investors' assets, liabilities, and correlation metrics right on this other side over here. And then we have an optimizer right over here, optimizer, like that. So this optimizer is where we are looking at, is where our focus is on, especially inclined towards asset allocation. The two approaches, or the two common approaches, is Black-Litterman approach as well as Monte Carlo simulation, like that, so that you can be able to optimize the returns of the portfolio, like that. So once you have the optimizer like that, then you have the asset mix, like that. Forgive my handwriting, it's just because we already covered this before. I'm just trying to bring you up to speed as to where we are. So the optimizer is over here, and then asset mix like that, and then the returns are actually generated just denoted by R, and then we have feedback loops moving around like this. And if you remember that lesson or that lecture that we had that I was explaining about asset allocation, please look at it or review it again. So under Black-Litterman approach, we will be able to look at two aspects. We'll be able to learn about the unconstrained Black-Litterman approach and the constrained, or the BL and Black-Litterman approach there. So to start us off, is to introduce what Black-Litterman is all about. So Black-Litterman. That. There are two gentlemen. One of them was called Fisher Black, and the other was called Robert Litterman, came up with an approach or approaches that can be used to deal with estimation error, especially when focusing on optimization there. So the Black-Litterman, the two gentlemen, the Fisher Black and Robert Litterman, came up with two models which we're saying are called unconstrained and constrained Black-Litterman model. So let's start by learning about the unconstrained Black-Litterman. Unconstrained Black-Litterman. Unconstrained Black-Litterman. So the main optimization approach is Black-Litterman approach, and we have two variants. The first one is unconstrained Black-Litterman. We are saying that this approach takes weights of asset classes in a global benchmark. For example, we are saying the Morgan Stanley Composite Index Global Index as a reference point or as a neutral starting point. And then we are saying that the asset weights are then adjusted to reflect the investor's views on expected returns according to a Bayesian procedure. Bayesian procedure there. And so we are saying that this unconstrained Black-Litterman assumes that the weights of the asset classes are going to be non-negative. You can put that in writing and say that this approach assumes weights of asset classes to be non-negative. And what that does is that this is what you're saying, that this is the benchmark over here. And if the allocations over here may be 10%, like that here, 15%, like that gives 25, and you have 25%, that asset class over there, another maybe say 25%, another asset class like that. So this up to here is 50, and this is 75, and then we put another 25% like that to that asset class over here. If this is real estate, there's UK equities, there's fixed income, there's derivatives over there, and we can be able to talk about other asset classes, including commodities and like that. So if this, of course, this one assumes that it adds up to 100% of the weights, and if this is the constituent of the MSCI Global Neutral or MSCI Global benchmark, and we are saying that the asset weights are then adjusted to reflect investors' view. So if the investor believes or feels that real assets is not going to perform very well over here, so we adjust it downwards to maybe 5%. This one maybe we increase it by another 5% like that. We are saying that we expect UK equities to actually outperform. And so here we put it at 20% like that. So that gives us 25%. This one to remain neutral or the same like that. So 25% also like that. And so that gives us a total of 50%. This one maybe goes down by 5% or by 10%. So this becomes 15% like that. And this one goes up by maybe say the same proportion like that. So this comes to 35%, totaling to 100%, and this one totals to 100%. Sorry, 100% like that. So it is unconstrained because we are saying that we don't have negative weights right over here. And negative weights arise from the point where we actually borrow like that. We borrow from the market so that we can be able to now ensure, and this total over here might actually lead to maybe greater than 100% like that. So maybe 120%, of course, like that. Obviously, knowing that 20% has been borrowed. So experts are expected to know that if it goes to beyond 100%, that 20% will to 120, from 100 to 120%, and the 20% is actually been borrowed like that. And so there's an interest component that has to be considered, and that really will be able to complicate the whole estimation procedure under the BL approach. So this BL, which is saying is Black-Litterman, in brackets you can put as this is not the BL, it's just Black-Litterman approach. So this is the UBL, sorry. So this is UBL. Unconstrained Black-Litterman assumes that weights are non-negative, and as you can see over here, that's what happens like that. So the estimation of the asset allocations are actually considered to be positive thereon. So with that, we can move on to the second approach, which you're saying is the Black-Litterman approach, which you're saying is the BL approach there. So number 2 is the Black-Litterman approach, or Black-Litterman approach like that, yes. Black-Litterman approach, saying which is BL, like that. This approach reverse engineers the expected return implicit in a diversified market portfolio. In essence, you are saying that we try and look for how much expected return, looking forward, how much we actually desire in terms of expected return. So if this is the benchmark and says it gives 15%, we can be able to now just try and forecast something beyond that. So we expect an expected return of 20%. So this is the benchmark, and this is what you expect. That's why it's called expected return. So you expect to get 20%. And then we are saying that we reverse engineer, we work backwards to try and identify the views on the investor and try and see whether those views are actually practical in the realization of these 20% returns. Are the allocations okay? So we want 20% expected return. So we work backwards now. Based on the investor's views, opinions, or assumptions, are those allocations going to enable us realize this objective of 20%? So that is what we're actually saying there. So I was right over here saying that this approach reverse engineers the expected return implicit in a diversified market portfolio and combines them with investors' own views on expected return and considers his or her own individual opinion. So this should have been his or her own individual opinion. Individual opinion or assumptions. Like that. So we try and see 20%, 20 or 25, let's say 20%. This is the expected return we expect. We try and analyze it and work backwards to see whether the assumptions will actually lead to realization of this 20% like that. So this is what we're saying is the Black-Litterman approach, and we're saying that it is different from the unconstrained Black-Litterman approach in the sense that this one does not consider non-negative weights. To some extent, this BL model might consider negative weights. Some element of short selling might be implicit under the Black-Litterman approach. I'm going to demonstrate the BL model using an example. The example is as follows. Eugene is not a professional investor and is reticent in expressing any opinion about future asset returns. The average risk tolerance for Eugene is as follows. Number one, if he were constrained to invest only in 5 asset classes given in the table below, what would be his opinion, his optimal asset allocation? Forgive me for that. Number 2, how would your answer in part 1 change if Eugene had below average risk tolerance? And so from the question, it is clear that Eugene has average risk tolerance. The appetite for Eugene to take up more risk is considered neutral or is average there. So to answer the first part of the question, so we can say solution. Part 1. If Eugene were constrained to invest only in 5 asset classes in the table below, what would be his optimal asset allocation? So based on the table, we can see that the asset allocation would remain because he does not have increased appetite for risk. He is just a neutral investor. And so those asset allocations over there, the percentage weights which have been provided for you there on the table remain as is. So we can say according to the Black-Litterman approach, so according to the BL approach, we can clearly see over there, according to the BL approach, Eugene should invest in how many asset classes? In 5 asset classes. Eugene should invest in 5 asset classes. And the 5 asset classes are weights, asset class weights. Asset class weights as follows. Remember, he is a neutral investor or he has average risk tolerance. So the asset class weights remain. And so you can see from the table over there, A, 57%, 57% in the what asset class in the Dow Jones, DJGI, the Dow Jones Global Index, Americas. B, we can see 6% in the DJGI, Asia Pacific excluding Japan, Asia Pacific excluding Japan, C, 17% in DJGI, Europe / Africa, excluding the UK, and South Africa. Including the UK and South Africa. D, 10% in DJGI, Japan, the Dow Jones Global Index for Japan, and E said 5 asset classes, the 10%. So 10% in the DJGI UK. So this is for a risk neutral investor or for a risk average risk tolerance investor. Part 2 of the question reads as follows. How would your answer in part 1 change if Eugene had below average risk tolerance? So we still use the Black Litterman approach. That's what you're actually using. So allow me, I can wrap this. And we're saying that following the Black Litterman approach, Eugene should still hold the 5 asset classes in, of course, the market value weights because he holds no view on the asset classes, so to speak. So we are saying that he would combine the portfolio with the risk-free asset to lower the overall risk exposure, like that. So what would happen is that we would be able to have solution 2. So I'll read again. Following the BL, or Black Litterman approach, Eugene should still hold the 5 asset classes in their respective weights and would combine the portfolio with the risk-free assets to lower the risk. He holds no views. Simply said that he holds no views on the asset classes. So if he doesn't have any view on the asset classes, then we still retain them like that. So we're saying, and would combine the portfolio with risk-free assets to lower the risk. Because risk-free assets include treasuries or treasury bonds and also maybe say corporate bonds to some extent. A, 57% in Dow Jones Global Index Americas, 6% in Dow Jones Global Index Asia Pacific excluding Japan, 17% in Dow Jones or DJGI Europe / Africa excluding the UK and South Africa, 10% in DJGI Japan, 10% in DJGI UK there. Now, having learned about the black letterman approach, the two approaches and the black letterman approach, we can be able to proceed and learn about the Monte Carlo simulation. So right over here we have Monte Carlo simulation. Right there. And under the Monte Carlo simulation is usually a statistical modeling tool used to complement the minimum variance optimization. If you recall, the minimum variance optimization we had said is to have something like so, and to try and plot that efficient set like that. So these represent the efficient set portfolios over here, like that, so on and so forth. So these are inefficient portfolios right over here, outside like that. But the ones that do not fall on the line like that are considered to be inefficient. And this is what we said, the GMV, or the minimum variance optimization, is as we move along the curve towards the left like so, we are minimizing this risk right over here like that. And this is what you're saying represents the risk, and this is the expected return, or rather expected return is the other way around. Expected return, and this is risk in form of SD like that. So as you move along over here like that, yeah, it's actually correct the way I had actually initially said it. Sorry about that, because we are reducing the element of risk per unit expected return. So this is SD. So as you move like this, yes, you're lowering the expected return like that, but you're also lowering the component of risk of exposure towards risk like that. And using what we call simulation techniques, we can be able to come up with an asset liability management approach that can be able to specify asset classes there. So an example to try and demonstrate Monte Carlo simulation is as follows. Edward has sought the advice of an investment advisor concerning his retirement portfolio. At the end of 2003, he is 65 years old and holds a portfolio valued at $1 million. Edward would like to withdraw $50,000 a year to supplement the corporate pension he has begun to receive. Given his health and family history, he believes he should plan for a retirement lasting 20 years. He is also concerned about passing along to his two children at least the portfolio's current value when he passes on. Consulting with his advisor, Edward has expressed his desire quantitatively. That is, he wants the median value of his bequest to his children to be worth no less than his portfolio's current value of $1 million. The median is the most likely outcome. The asset allocation of his retirement portfolio is currently 50-50. That is, US equities 50%, US intermediate term bonds 50%. Edward and his advisor have decided on the following set of capital market expectations. Number one, US equities. Expected return is 12.4%, standard deviation of 20.4%. Number two, US intermediate term bonds. Expected return 5.6%, standard deviation 5.7%. Number three, predicted correlations between the US equities and US intermediate term bonds is 0.042. Finally, number four, the long-term inflation rate is 3.1%. With the current asset allocation, the expected return on Edward's retirement portfolio is 8.9% with a standard deviation of 10.6%. A Monte Carlo simulation is used so that it can be able to predict the possible scenarios. Number one, justify the choice of presenting ending wealth in terms of real rather than nominal wealth based on the graph below. Number 2, is the current asset allocation expressed to justify Edward's investment objective? So in trying to answer part 1, we are saying that you justify the choice of presenting ending wealth in terms of real rather than nominal wealth terminology there. And the solution to problem 1 is that we want to have, or the advisor who is advising Edward wants to have a median value of his bequest. This means that that bequest is going to be given to his children and to be no more than his portfolio's current value of 1 million. So we need to state the future amounts in terms of today's values, so that we can be able to assess their worth relative to the 1 million shillings today. So the above graph gives us possible scenarios or the results of the Monte Carlo simulation, as you can be able to see from your screen there. In trying to answer part 2 of the question, we can deduce, or we are being asked, is the current asset allocation expected to satisfy Edward's investment objective? And we can see from the above graph, which is shown on the screen, that the median terminal value of the retirement portfolio in real dollars is less than the initial 1 million shillings. So this means that the most likely bequest is less than the amount Edward has specified that he wants, and the current asset allocation is not expected to satisfy all his investment objectives. So you can be able to look from your screen over there on the possible scenarios over here, and that's why we are saying that Monte Carlo simulation is usually useful in trying to predict or forecast the possible scenarios or the possible effects of changing asset allocations there. This brings us to the end of the lesson, and so assignment. May 2016, question 4A. We hope that you have enjoyed today's lesson. We hope that you'll continue with us, still learning about asset allocation. Thank you and God bless you.
Greetings and welcome to the lesson. Today we are going to discuss the objectives of an audit plan, or in other words, objectives of audit planning. And candidates, a plan is a predetermined course of action. It could be a plan for auditing, it could be a plan for studying, it could be a plan for building a house. A plan generally is a predetermined course of action. You determine in advance what you want to do. Now, when carrying out audit engagement, it's important for an auditor to have an audit plan. And the objectives of audit planning are multifaceted. They are multidimensional, and they are crucial for ensuring the effectiveness, efficiency, and quality of an audit engagement. In this lesson, we would want to analyze some of the objectives of audit planning. And one such objective is that an audit plan helps the auditor to devote appropriate attention to important areas of the audit. To devote appropriate attention. A plan enables the auditor to devote appropriate attention of the audit. Because without a plan, the auditor may not devote proper attention to important areas of an audit. Planning helps the auditor identify and prioritize the areas of the financial statements and operations that carry the highest risk of material misstatements. And that ensures that there is sufficient audit effort and resources that are directed towards the critical areas rather than being spread thinly across all the aspects of the financial statements. That's the first objective of audit planning. The second objective is to identify and resolve potential problems. To identify and resolve potential problems in a timely manner. The second objective of audit planning is to identify and resolve potential problems in a timely basis or manner. On a timely basis. On a timely basis. How is that so? It is so through planning. Because through planning, auditors can anticipate challenges, they can anticipate complex accounting issues, or even potential areas of fraud or error. So addressing these issues early in the audit process is critical rather than encountering them unexpectedly later on. Because coming across these issues later on unexpectedly may waste the auditor's time and resources and reduce the likelihood of significant delays or scope limitations. So that's the second objective. The third objective of audit planning is to organize and manage the audit effectively and efficiently. That's the third objective of audit planning. It is to manage and organize, and manage the audit effectively and efficiently. An audit plan helps the auditor to manage and organize the audit process effectively and efficiently. Planning provides a roadmap for the entire audit. A plan is a roadmap. A plan is a blueprint. A plan states what should be done at what time. And that helps the auditor to manage and to organize the audit effectively and efficiently. It helps define the scope. It sets timelines. It allocates responsibilities to the team members. And also it helps to determine the necessary resources like personnel, like technology and all that. And such systematic approach prevents haphazard work. It also ensures that the audit stays on track and optimizes the use of the audit firm's resources. That's the objective of an audit plan. Objective number 4 is to assist in the selection of appropriate engagement team members. It assists in the selection of appropriate audit team members. An audit plan helps to assist in the selection of appropriate audit team members and also assignment of the work to them. So based on the assessed risks, based on the complexity of the client's business and specific areas requiring expertise and planning, It helps the engagement partner assign team members with the right skills and right experiences to different parts of the audit. And that ensures that specialized areas are handled by individuals who are qualified. Because before developing an audit plan, the auditor has to understand the business. Through understanding the business and before drawing the plan, the auditor knows what areas require specialized expertise. So it is through this plan that the auditor will then select appropriate audit team members to carry out the audit assignment. That is objective number 4. Objective number 5 is in relation to supervision and review of work. An audit plan can facilitate. It can facilitate supervision. It can facilitate the direction. It can facilitate and supervision. Supervision and review. Let me add review of audit. And how does an audit plan facilitate the direction, supervision, and review of audit work? Now, a well-developed audit plan provides clear instructions and expectations for the audit team, and that facilitates effective supervision by senior auditors and managers, enabling them to monitor progress, to address issues, and even conduct thorough reviews of the work performed by junior staff, thereby enhancing the quality of the audit. Now, the 6th objective of audit planning is assisting in the coordination of work performed. To assist in coordination of work. To assist in coordination of work performed by auditors of components and experts. To assist in coordination of work performed by components and experts. There are times when the auditor may rely on work of experts. And especially in audits of large and complex entities with multiple components like subsidiaries and branches, or those requiring the involvement of specialists like IT experts, valuers, and so on, planning is essential for coordinating the work of all parties involved. And that ensures that all relevant information is gathered and all such information is integrated effectively. So an audit plan will help in coordination of work performed by other experts. Objective number 7 is in relation to evidence, to obtain sufficient appropriate audit evidence. An audit plan helps to gather or to obtain sufficient appropriate audit evidence. Helps to obtain sufficient appropriate audit evidence for the circumstances. Because ultimately, the objective of an audit plan is to ensure that the auditor designs and performs audit procedures that will gather enough reliable evidence to support the audit opinion. So without adequate planning, there is a risk of insufficient or inappropriate evidence, which could lead to incorrect audit opinion. Objective number 8 is to maintain audit costs, at a reasonable level. To maintain audit costs at a reasonable level by promoting efficiency and focusing resources on relevant areas. Effective planning helps prevent unnecessary procedures and rework, thereby contributing to a cost-effective audit for both the audit firm and the client. Then lastly, candidates number 9, The last objective of audit planning is to avoid misunderstanding with the client. It helps to avoid misunderstanding with the client. It may help avoid misunderstanding with the client. A clear audit plan, often discussed and agreed upon with the client, sets expectations regarding the scope, the timelines, and the deliverables. Because there are times when the auditor may want to interview the management team. That has to be within the plan. The management team should know when the auditors are visiting so that there is no misunderstanding. So a plan can help to avoid such misunderstanding, and that open communication helps prevent disputes and also misunderstandings during and after the audit engagement. Because a clear plan should be discussed and agreed upon with the client. The auditor cannot just develop a plan without involving the client. When the client is involved, then they are on the same page. They will avoid any conflicts or misunderstandings. So these are 9 objectives of audit planning. The first one is to devote appropriate attention to important areas. Number 2 is to identify and resolve potential problems on a timely basis. Number 3 is to organize and manage audits effectively and efficiently. 4 is to assist in the selection of appropriate audit team members. 5 is to facilitate the direction, the supervision, and also the review of audit work. Number 6 is to assist in coordination of work performed by components and experts. 7 is to obtain sufficient appropriate audit evidence. Number 8 is to manage or to maintain audit costs at a reasonable level. Then lastly is to avoid misunderstanding with the client. That's all for today's lesson, in which we have discussed the objectives of audit planning. Bye-bye.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ngwiri and I practice within the financial services industry in Kenya. Ladies and gentlemen, we are learning about advanced portfolio management. The key focus on capital market focus. We dive a mile deep and talk about the application framework. Which application framework? Capital market focus framework. And so we are going to introduce the application of economic growth trend analysis. And we can mention the following, ladies and gentlemen, that the use of tools. Which tools are these? We're saying forecasting tools, ladies and gentlemen. The use of tools helps the analyst set capital market expectations. Stop there. Formal tools are those that are accepted or acceptable within the investment community. Within the investment community. Or what we can be able to say the financial services industry, ladies and gentlemen. So we begin by talking about statistical tools. So statistical tools. Because we're talking about capital market focus and we are trying to analyze economic tools that are used to try and predict capital market expectations. So we can say something that descriptive statistics tries to summarize data, summarizes data data. Inferential statistics, uses data to make forecasts. Uses data to make forecasts. Let's stop there for a bit. What are we saying? We are saying that the use of tools helps the analyst set capital market expectations. Formal tools, ladies and gentlemen, the key word there is formal tools. Formal tools are those that are accepted within the investment community, the financial services industry. So we are saying now, we are diving a mile deep by talking about statistical tools, statistical forecasting tools. Descriptive statistics summarizes data, perhaps in graphs, charts, and so on and so forth. Inferential statistics over here uses data to make forecasts there, predictive models like that. So breaking it down a bit, we can mention the following, that when trying to predict returns, within a single period, we can say a simple arithmetic average is used. An arithmetic average is used. So we are saying when trying to predict returns within a single period, an arithmetic average that is underlined, double underlined, is used. How about for multiple periods? That's when, ladies and gentlemen, we discuss about the geometric average or geometric mean. So we mentioned over here that when trying to predict returns in multiple periods, and or a geometric mean, a geometric mean is used. A geometric mean is used. So if you have returns for period 1, 2, 3, 4, and 5, like that, and we have periods, these are periods, and the returns we have maybe say X percent, Y percent, Z percent, V percent, and U percent over here. So let me just distinguish it over here, and O percent like that. We're saying under single period model like that, if you're saying that you're trying to analyze data within a single period, you get an arithmetic average over here of that period. So X percent, so we can assume that this is one complete cycle over there. Or if for purposes of maybe simplicity, maybe say you have within 1 year, you have quarter 1, quarter 2, quarter 3, and quarter 4, because this is one period like that. You get X percent, Y percent, Z percent, and V percent like that. So this is 1 year like that. And for us to use a simple, this is because it's one period, we just get an arithmetic average mean by saying you get X percent plus Y percent plus Z percent plus V percent all over 4. It's one period. But when trying to extrapolate that into multiple periods, 1 year, 2 years, 3 years, 4 years, and 5 years, and so on and so forth like that, is when we use the geometric average, trying to come up with a predictive model. Yeah, so the geometric average now in this case is where we are going to get now the nth root over here. So in this case, it's the 5 periods. So you have the 5th root of 1 plus x, of course in percent, x percent, 1 plus x percent, like that, 1 plus y percent, z plus 1 plus z percent, and then we have 1 plus v percent, 1 plus o percent, like that, up to there, and then minus 1 there. So we first of all get this. What does it mean? It means first of all we get the nth root, in this case it's the fifth root, of the product of these returns over here, and then we less 1 after we've gotten the fifth root there. So that is what we're saying, we apply a geometric average. So moving on, we are saying that another approach can be used when estimating equity returns by the use of bond yield plus risk premium. By the use of bond yield plus risk premium. Bond yield plus risk premium. So what are we saying? We're saying that another approach can be used when estimating equity returns by the use of bond yield plus risk premium. So you just get the bond yield, or the yield of, say, a 10-year bond. What is the yield? So the bond yield over here, and then we add the risk premium. Risk premium, remember, from CAPM, we're talking about RF plus RM minus RF, like that, and then we multiply that by beta y. This is a measure of systematic risk there, and this is of course the risk-free rate over here, and we're saying the bond yield can be representative of that component there, the risk-free rate. Then the risk premium is just the difference between the market return, ladies and gentlemen, and the risk-free return over here. So this is the equity risk premium over here. So what we're saying, that we don't include this measure of systematic risk. We're just going to get it up to that level, and then we add those two. The bond yield plus risk premium, excluding factor sensitivities, ladies and gentlemen, there. Having mentioned that, we can talk about other models there. So statistical tools, the first statistical tool, ladies and gentlemen, is the descriptive statistics over there. Graphs, charts, and so on and so forth. Inferential statistics, we are saying, uses data to try and make forecasts by coming up with models that can be able to extrapolate it into the future, or extrapolate that data into the future. Now, another approach over here is what you're saying is the bond yield plus risk premium. So I hope you're taking notes as we're discussing like that. So the bond yield plus risk premium approach is also another tool that is used to predict economic or conduct economic analysis into the future. And we're saying what? We're saying other tools include, so time series models are also used to make estimates that assume the past value of variables is at least in part, a valid estimator, valid estimator of its future value, its future value, Stop there. They are used to make estimates in the near term. They are used in practice to make estimates in the near term, or what you can say in the short to medium term period there. So let's recap. Time series models, important model, are also used to make estimates that assume the past value of variables is, at least in part, a valid estimator of its future value. They are used to make estimates in the near term. So time series models, as we move along, we'll be able to try and showcase examples of how we can be able to use time series models or even statistical tools in lump sum so that we can be able to at least understand the tools used within the investment profession. So over on this other side, ladies and gentlemen, we are talking about another approach or another statistical tool, ladies and gentlemen. So we are saying it's volatility clustering. Volatility clustering. And we can say has been observed where either high or low volatility, tends to persist at least in the short run. Volatility clustering. So some models have actually been developed in practice by foreign bodies or foreign institutions such as JP Morgan Chase. And we are saying that volatility clustering tries to to group data that has got similar attributes and tries to use that data to try and make inferences into the future there. So what are we saying? We're saying volatility clustering has been observed where either high or low volatility tends to persist at least in the short run. Another statistical tool that is used in practice, ladies and gentlemen, is multi-factor models. So multi-factor models can be used in a top-down analysis to forecast returns based on sensitivities, and we are saying beta and risk factors. A two-factor model takes the form, ladies and gentlemen, y is equals to b0 plus b1 x1 plus b2 x2 plus an error term there. So these, the b0, b1, b2, this represent factor sensitivities. This is the intercept over here, the y-intercept. When x is 0, what is the value of y? That is the intercept there. And this one represents the factor sensitivity and that relates to this factor. This factor sensitivity that relates to this factor right over here. And all these, the x1 and x2, influence y there. If it influences y, then we need to try and magnify or try and see what can be able to increase the returns right over here, or coming up with a predictive model that is useful in predicting returns into the future there. And so once we've discussed about statistical tools, descriptive statistics, inferential statistics, we've also discussed about the bond yield plus risk premium approach, the time series analysis, and also volatility clustering as well as multi-factor models. We are saying that multi-factor models can be used in a top-down analysis to forecast returns based on sensitivities, beta, and risk factors. A two-factor model is shown to you right over there. After statistical tools, our next stopping point is what we call, say, discounted, rather dividend discount models. Dividend discount models. So because of consistency, ladies and gentlemen, I wrote it in capitals, so here I need to also put in capital letters over here. Dividend discount models. There. So, ladies and gentlemen, before we go into, actually it's supposed to be discounted cash flow models, not dividend discount models. Dividend discount models, of course, ladies and gentlemen, has been discussed in equity investment analysis, so my apologies for that. Before we move ahead from this point over here and discuss about discounted cash flow models as an alternate to try and estimate economic growth rates or to try and predict the future or conduct trend analysis, we can be able to look at an example how we can be able to apply statistical tools there. So the example is based on a two-factor model over here. And over here, of course, is an example of a two-factor model. So the question goes as follows. Tom Jones is a senior strategist examining equity and bond markets in countries C and D. He assigns the quantitative group to prepare a series of consistent calculations for the two markets. The group begins at level 1 by assuming there are two factors driving the returns for all assets, a global equity factor, that is, and a global bond factor. At level 2, this data is used to analyze each market. The data used is shown in the tables below. So you can see factor covariance matrix for global assets, that is, global equity factor and global bond factors have been provided on both sides. So moving down in first column, we have global bond factor, global equity factor, global bond factor. Then the second column, we have global equity factor 0.0211, then 0.0015, that is the covariance. Then global bond factor 0.0015, that's the covariance of F1 and F2, and the variance is 0.0019. You can see it there. The second table, you have factor sensitivities for the countries. So we have country C and D, the global equity sensitivity there, and the global fixed income values for both countries C and D have also been shown to you there. So we are saying what? We are saying that you can be able to clearly see that the 0,0 sensitivities in table 2, as you can see there, indicate that that both markets are equity markets, ladies and gentlemen. So both markets are equity markets, and that means that the correlation between each market and the global bond market is 0, which means that once the effect of the equity market is controlled, ladies and gentlemen, for the partial correlation of each market, the global bond factor remains 0. So in trying to conduct what we're saying over here, a two-factor analysis over here, we can be able to see that the covariance C and D, so solution, it over here. So covariance CD is given as follows, ladies and gentlemen. So we are getting the beta for market C, using factor 1. Then we multiply that by the beta of market D for first factor, times the variance based on factor 1. Then to that we add the beta for the beta for market C, second factor. This is the second factor, this is the first factor. First factor, first factor, first factor. So we do the same but now for the second factor. That. Then we multiply that with beta for market D, second factor. Then we can be able to now do or conduct the variance of factor 2 like that. Plus, ladies and gentlemen, plus we have beta for C market 1, beta for market D, factor 2, plus beta C for the second factor. So we've done first factor, second factor. So we are going to do second factor, first factor like that. So beta for C for the second factor, and then we multiply beta for D for the first factor right over there. We close the bracket because we've opened the bracket right over there, and we continue and say covariance, 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 F1, F2. I hope you've understood what we're doing. We're trying to get the covariance of market C and D. So for us to get the covariance, we are going to get, first of all, the beta for market C, the first factor, beta for market D, the first factor, variance for factor 1. Then we get the beta for factors for market C, factor 2, beta for market D, factor 2, for market D, factor 2, and then the variance, factor 2, like that. And then we just multiply it by this component over here, the beta or the factor sensitivities for market 1, factor sensitivities for market 2 over there under factor 2, the factor sensitivities for market C under factor 2, factor sensitivities for market D under factor for market D factor 1, then times covariance factor 1 and factor 2 there. So putting it all together, if you allow me, I can come on this other side, ladies and gentlemen. I can come here. We are saying what? So the specifics in terms of the value. So covariance CD is given as, we're just repeating what we've just written over here, but now putting the values there. So we are putting it 0.9 multiplied by 0.8 multiplied by 0.0211 plus. So that's the first component over here. That component there. Another component there, and then there's that component there. That's the first component. And then we have 0 multiplied by 0 and multiplied by, ladies and gentlemen, 0.000019, like that. That's the second component there. And then we are adding what? Now we are adding this part over here like that. So we are adding 0.9 times 0, that part there, plus 0 times 0.8, like that. And then we multiply by the covariance of factor 1 and factor 2. Covariance of factor 1 and factor 2 from the table is given to us there, I can see as 0.0015. So how much do we get for this over here? Pick my calculator very fast. Here, work it out. At 0.9 times 0.8 times 0.22, 0.211 plus that, 0, that's 0 plus that, 0.11 there. I'm getting 0.0152. 0.0152. That is the covariance of market C and D. Once we've gotten that, then we can proceed on to also estimate the variance for market C. How do we estimate the variance for market C? So variance for market C over there. And how we estimate the variance is given as the following formula over here. Variance is given as beta squared C market 1. Then we multiply by the variance of factor 1 plus we get beta squared of C2 multiplied by variance or variance over there of factor 2, that plus 2 beta of C1 beta of D of C2, sorry, C2, C1, C2, beta of C1, C2, and then covariance F1, F2 over there, plus what we are saying, the variance of the error term, market C. So we're dealing with market C, ladies and gentlemen. That's why we're saying we're just doing C, 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 like that. How about for D? We'll do the same, but now we'll be able to do with the values for D. So putting it all together, you can have the values as follows over here. So variance squared is equals to division squared is given as we are having 0.9 squared multiplied by 0.211, 0.211, because we're saying that this is the variance, ladies and gentlemen. This is the variance. So it's 0.0, pardon me, 0.0211 there, like that. And then we are adding, we have 0 squared multiplied by 0.0019, close the bracket over there. So we're multiplying that, like that, sorry. So 0 times that value there. And then we are saying we have 2, we are at this part over here, 2, this part over here, beta C1, beta C2, covariance F1, F2 plus that value there. So 2 multiplied by 0.9 multiplied by 0 multiplied by 0.0015 over there. So how much do we get for the variance for this market here? So working it out very quickly, so I have over here, so I'm getting, ladies and gentlemen, 0.0, getting 0.0171171. That is the variance over there. But what about standard deviation? So we get standard deviation is given as 0.0171. We get the square root of that. That's what we get over there. So if we get the square root, so square root of 0.0171, we get a standard deviation of 0.13. How about variance for market D? We use the same formula, but I'm just going to now indicate, so standard deviation squared is given as beta squared for D1, standard deviation squared of factor 1, then plus beta squared of D2, factor 2, variance squared of factor 2. We're saying we have factor 2, yes, factor 2 like that. And then plus, now we are repeating the part that has got that constant 2 there. So 2 beta D1 beta D2 covariance F1 F2 plus standard deviation error term there. So putting it all together, how much do we have? So we have 0.8 squared multiplied by the variance 0.2 0.0211 there, then plus we have 0 squared there, then multiplied by of course here there's multiplication by 0.019 plus 2 times 0.8 multiplied by 0.0015 over there. So how much do we get for this value here? So very quickly, just work it out. So I'm getting 0.0135. 0.0135 like that. And having computed the variance for market C, variance for market D, we are saying that the variance for the markets will tend to be higher. As shown to your screen there, ladies and gentlemen, this is the analysis you can be able to come up with. That the variance of the markets will be higher than the estimated because the analysis has not accounted for the variance for the residual risk. That is the error term component there. Each market will have residual or idiosyncratic risk not explained by the market factor sensitivities right there. So moving on, we now discuss about discounted cash flow models. This is the second type of model that we're discussing. So the first one we've been discussing is statistical models. So let's move ahead and discuss about discounted cash flow models. I had initially made an error and said it's a discounted cash flow, discounted dividend discount model. But now what I'm saying is discounted cash flow models. So discounted cash flow models, I'll use a different color now. So the topic, because it's a subtopic, we could talk about discounted cash flow models. And the major discounted cash flow model is, of course, derived from the discounted dividend model, the Gordon growth model, ladies and gentlemen. And the Gordon growth model over here, we are saying is what? Is just, so value is given as D naught 1 plus G all over R minus G over there. This is the required return, this is the growth rate, this is the dividends. Remember this component over here, this one E represents historical dividends. The D naught represents historical dividends. This can be rewritten as or V in the value, the intrinsic value D1 over R minus G. If we have forecasted dividends, if that part is forecasted, over here is historical. It's historical, it's D naught. So the keywords there you should be able to see is dividend just paid, current dividend, past dividends, and so on and so forth, like that. But when you have a forward-looking approach, some words that represent forecasting or a forecasted approach, we can say it is, say, the expected dividends, future dividends, forward-looking components, so on and so forth, like that. So this model, of course, can then be, when making R the subject of the formula over there, just on rearrangement of this one, not this one over here. So we're making R the subject of the formula, we're saying we should be able to have, when we make R the subject, we have the following, and we have R is given as D1 over V plus G, like that. And of course, R, required return, V, intrinsic value, G, growth rate there, and dividends, forecasted dividends. Greenwald Cronum was an individual who took this model a little bit further. Let's see together what he actually said. So, on advancement, of the Gordon growth model, Greenwald and Kroner took it further. Remember, I talked about coming up with forecasting tools. Talk about discounted cash flow models. So we have over here D1 over P naught plus I plus G minus change in S plus change in the price to earnings ratio, change in P stroke E, like that. Where this represents the dividend yield. I represents X. This is, by the way, expected. It's expected. I, expected rate of inflation. Expected inflation. Moving over on this other side, we're talking about G, real growth rate. And then we have change in S as the change in the number of shares outstanding. Change in the number of shares outstanding. That. How about the change in PE? Change in P stroke E, you are saying is a change, is percent change or percent change, like that, percent change in level of PE, percentage change in price to earnings ratio, percentage change in price to earnings ratio. We can then, of course, deduce a few things, ladies and gentlemen. What can we deduce? We can just group this in what we can say in a simple form. This formula over here can actually be regrouped as follows. So in terms of the income return, we can say it's just given as D1 over P naught minus change in S. That is the component of the income return. So this part here and the change in S, of course, we're saying we're including the sign, ladies and gentlemen, represents income return. Moving on, we can say the nominal earnings growth. The nominal earnings growth, ladies and gentlemen, is denoted by I plus G, the nominal earnings growth. So this part here, I and the G have actually been settled and very well. Nominal earnings growth rate. And the repricing return, finally, repricing return is given as change in P stroke E. So in the exam, you could be given some inputs that can be able to assist you to come up with a predictive model based on this Greenwald-Kroner model. So this first component is called the income return. This one is called the nominal earnings growth rate, I plus G, and the repricing return is given as change in PE ratio. So ladies and gentlemen, I can give out, we can do a question together. So the example is as follows. Suppose an analyst estimates a 2.1% dividend yield, real earnings growth of 4%, long-term inflation of 3.1%, a repurchase yield of negative 0.5%, and a PE repricing return of 0.3%. So we are saying what? We are saying that the total expected return on the market will be based on computing these three returns. So we can be able to do it together right over here. So we are saying we have the expected current yield, expected current yield. The expected current yield is given as the dividend yield plus the dividend yield plus repurchase yield. Plus repurchase yield. And so we're saying we have 2.1% plus purchase yield is being given to us there, the purchasing return, which we're saying is repurchase yield is negative 0.5%, negative 0.5% over here. So very quickly, my calculator. Yes, I'm getting 1.6%. Once we get the expected current yield, then we can move ahead, ladies and gentlemen, and compute the expected capital gains yield. Expected capital gains yield. Expected capital gains yield, as you can be able to see, is given as real growth plus inflation. Real growth plus inflation. And then over there, plus repricing. Repricing. Yeah, which is saying the real growth given to us there is 4%. Then we add 3.1%. And then we add 0.3% of the repricing, 0.3% repricing. So we are getting how much? We're getting 7.4%, like that, because we're saying 4, 5, 6, 7, then 0.3 plus 1, like that, 7.4%. Once we get that, that represents, so the total expected return on the stock market, total expected return on stock market, total expected return on stock market is given as the 7.4%, 7.4%. Plus, we are saying this value of 1.6%, like that. And you're saying we are getting around 7, 8, looks like 9%. 9%. That is what you're saying is total expected return on the stock market there. So we can then move on from here and discuss how we can be able to predict fixed income returns. Predicting fixed income returns. So fixed income returns. So fixed income returns. So if we were to label, of course, we talk about, first of all, the statistical tools as being A, and then we talk about discounted cash flow models as being B, and this is now what you're saying is our C, fixed income returns. And fixed income returns can be measured or can be estimated. These returns can be estimated using what we can say a discounted cash flow analysis, discounted cash flow analysis, discounted cash flow analysis, or the risk premium approach as explained before over here, right over here, In this part over here, we are seeing is a dividend discount model or discounted dividend model and a Gordon growth model, as explained before, or a risk premium approach, or using a risk premium approach. Risk premium approach. So we're saying the return is computed, the forecasting return, trying to forecast, we're trying to forecast returns. So the return is given as risk-free rate. Then, ladies and gentlemen, we add premiums. So we add what we say inflation risk premium, inflation risk premium. Then we also add what we can say default risk premium, like that. And then we also add additional components for illiquidity risk premium, liquidity risk premium. And then we add what we can say maturity risk premium, maturity risk premium. And finally, ladies and gentlemen, and most important, we can be able to add tax premium plus tax risk premium. That. So what are we saying again on fixed income returns? These returns can be estimated using a discounted cash flow analysis, as explained before, or using a risk premium approach. As explained before, we've already explained it in the previous subsection over here. And now we can also use a risk premium approach. As explained before, we are talking about the bond yield plus risk premium approach. Now here we're talking about a premium using a risk premium approach, which is a different format. So forecasted returns is given as the risk-free rate. Then we add inflation risk premium, changes in the prices of goods and services. Default risk, the rate at which default will occur in terms of fixed income instruments or corporate bonds. We're talking about illiquidity risk premium, the change in liquidity levels within the market as derived by the fixed income and the trading that occurs within fixed income airspace. Then we also talk about maturity risk premium, and finally the tax risk premium. This maturity risk premium is based on bullet and barrel structures there. And bullet is where you concentrate payments on a specific point, or maturities around the maturity date. You concentrate bonds or bonds which have got similar maturity along the maturity date. And tax risk premium, where we talk about the risk of paying higher taxes when going for infrastructure bonds vis-a-vis treasury bonds there. So this brings us to the end of this subsection where we talk about economic trend analysis. In our next lesson, still under application of economic growth rates, we build on other models that can be able to move us ahead in trying to forecast expected returns. So I will leave you with an assignment right here. The assignment I have is explain the statistical tools, discounted cash flow analysis, discounted cash flow analysis, and the, what you can say, fixed income returns analysis models, and the fixed income returns analysis, fixed income return forecasting methodologies. explain the statistical tools, that's the first one we've discussed, discounted cash flow analysis, and the fixed income return forecasting methodologies. Thank you for being with Manifested Publishers. Bye-bye.
Greetings, candidates. Welcome to the study of the subject leadership and management. And in my hand, I have the Kasneb syllabus that was released in 2021. 2021 Kasneb revised syllabus for paper number 13, leadership and management. This paper was renamed from strategy, governance and ethics. And in our today's lesson, I'm going to do an adumbration of this subject. The unit description is as follows. The syllabus reads that this paper is intended to equip the candidate with knowledge, skills, and attitudes that will enable him or her to apply and demonstrate leadership and management skills to grow an enterprise under various circumstances and environments, including under uncertainties. That is the main objective of studying leadership and management. It is to equip the candidate with knowledge, skills, and attitudes that will go a long way to enable the candidate apply and demonstrate leadership and management skills in order to grow an enterprise under various circumstances, various environments, including uncertain environments. The syllabus also lists 5 learning outcomes. A candidate who passes this paper should be able to, number 1, demonstrate an understanding of leadership techniques and management principles. Leadership techniques and management principles. Number 2, apply knowledge of leadership and management theories in organizations. Number 3, effectively undertake management functions. Number 4, make rational management decisions in an organizational context. Then lastly, embrace and manage strategic change. These are 5 learning outcomes. Now, candidates, the content is organized in 12 topics. 12 topics. The first one is Introduction to Management. Number 2, Evolution and Development of Management Thought. Number 3, Leading as a Function of Management. Number 4, Other Functions of Management. Number 5, Environmental Analysis. Number 6, Leadership Approaches and Strategy. Number 7, Decision Making. 8, Enterprise Management. 9, Project Management. 10, Marketing Management. 11, Leadership and Strategic Change. Then lastly, Case Studies in Leadership and Management. Case Studies in Leadership and Management. These are 12 topics. 12 topics. And candidates will be covering each topic at a time. Each topic at a time. For example, the first topic, Introduction to Management, we will study the nature of management, importance of management, levels of management, multidisciplinary nature of management, roles of management as advocated by Henry Mintzberg, the changing roles of managers and management, qualities of an effective manager, management and
administration. These are the subtopics under the first topics. Then in topic 2, there are 3 categories of evolution and development of management thought. Is organized in 3 subsections. Number 1 is the classical approaches to management. Number 2, behavioral management approach. Then modern management theories. The third topic, leading as a function of management, will study differences between management and leadership. We'll study attributes and skills of a good leader. We look at the delegation, responsibility, and accountability. Then we will cover power, authority, and accountability. In topic number 4, which is known as other functions of management, we will discuss the planning function, the organizing function, the staffing function, and the controlling function. Topic number 5, which is environmental analysis, we are expected to cover microenvironment, macroenvironment, internal environment, external environment, and tools of environmental analysis. Then in topic number 6, leadership approaches and strategy, we look at the leadership traits, leadership styles, leadership skills, formulation of an organization's strategic direction, differences between transactional leadership and transformational leadership, conflict resolution mechanisms, then ethics in leadership. In topic number 7, we'll discuss the importance of decision-making models, types of decisions, decision-making process, problem-solving skills, decision-making under different conditions, challenges in decision-making, effective, and lastly, effective decision-making. In topic number 8, we are expected to study the meaning and concept of entrepreneurship, entrepreneur development, enhancing creativity and innovation in organizations, methods of generating ideas, introduction to business plan, protection of intellectual properties. That is the last subtopic in the study of enterprise management, protection of intellectual properties. In topic number 9, candidates are expected to cover number 1, project management concepts. Number 2, characteristics of a project. Number 3, importance of projects. Number 4, features of projects and baseline surveys. Number 5, illustration of the project life cycle. Number 6, project planning and organizing. Number 7, project resources and costing. Then lastly, number 8, project completion and evaluation. In topic number 10, known as marketing management, we will discuss the meaning and importance of marketing. We will look at the marketing management orientation and or philosophies. We study the marketing mix. We'll discuss the development of marketing information. Number 5 is the marketing strategies. Then we have marketing research and intelligence. And lastly, international marketing and e-commerce. Topic number 11, leadership and strategic change. We will consider the meaning of change, theories of change, types of organizational change, managing resistance to change, organizing the change context, levers for strategic change, methods of introducing strategic change, problems of formal change programs, leading change is the last subtopic under leadership and strategic change. Then lastly, there is a case studies in leadership and management. Case studies, we will discuss or look at different case studies in leadership and management. So candidates, these are the areas that you are expected to study in your endeavor to gain knowledge, skills, and attitudes that will enable you to apply and demonstrate leadership and management skills to grow an enterprise. And that should be done under various circumstances. You're expected to manage an enterprise under various circumstances and environments, including uncertain environments. So I hope, candidates, you will be joining us in all the lessons. We are going to cover each and every aspect of this syllabus. It is expected that as we go through this syllabus, when you join these classes, make sure you take down notes. If you have questions, you are free to post your questions. Below this syllabus, there is a comment section where you can ask questions. Make sure you also practice active recall. Carry out continuous revision. Over and above the video lectures, we have also developed the study materials, study texts, and revision books based on the revised syllabus that was promulgated in the year 2021. The books are updated and they cover all these areas that we've mentioned. So make sure you study ahead. Study ahead. Always study ahead. Make sure you familiarize yourself with the various aspects of the syllabus, and as we progress with this coverage of this syllabus, make sure you always go back, answer questions, past paper questions, because some of the topics in leadership and management were retained, because I remember I said that this subject, leadership and management, was just renamed. In the old syllabus, the paper was known as strategy, governance, and ethics. There are certain topics that were maintained, like the first one, introduction to management. There is a topic on evolution and development of management thought. Other functions of management were also retained, like the planning function. We covered it in the previous syllabus, organizing function, the staffing function, controlling function, and even leadership approaches and strategy. These are some of the topics that were retained in this current syllabus. All right. The only new topics that were introduced here I can see is enterprise management. Some subtopics are enterprise management. Project management is also a new topic, including marketing management. Though candidates in the old syllabus, when some of us were studying this course, we studied project management and marketing management. These topics have been reintroduced in the syllabus. So you can see, candidates, we have past paper questions from these areas that I've mentioned. So as we progress, make sure you revise, look at the past paper questions from our revision partners. Check our revision partner. We have past paper questions with solutions. So as we progress with the coverage of this syllabus, make sure you carry out continuous revision. Don't wait at the last minute in order to revise. No. Continue revising. When, for example, when you are done with topic number 1, go to the revision books, look at the questions that have been tested in the past under this topic, because in the revision books, we have organized the questions topically. So it's very easy for you to locate questions based on the topic that have been that we are covering in the subject leadership and management. So candidates, thank you for choosing to study with the Manifesto Publishers. We endeavor, we plan, we are ready to help you gain the required skills, the required attitudes and knowledge that will enable you meet the objectives that I read here. Remember, by the end of this training, number 1, the syllabus states that you should be able to demonstrate an understanding of leadership techniques and management principles. Number 2, you should be able to apply knowledge of leadership and management theories in organizations. Number 3, you are expected to effectively undertake management functions. Number 4, a student or candidate who passes this paper should be able to make rational management decisions in an organizational context. Then lastly, you are expected to embrace and manage strategic change. It's not just about knowing the principles or memorizing a few concepts. No, at the end of the training, it is envisaged that you should embrace and manage strategic change among the other objectives that I have read. So that is our intention. That is our purpose, to equip you with the knowledge, with skills and attitudes that will enable you to apply and demonstrate leadership and management skills that will enable you to grow an enterprise under various environments or circumstances, including environments and circumstances that are uncertain. So you can see, candidates, the training is not limited to you passing the exam. The skills that you gain here should enable you to demonstrate, to practice, to manage, to apply, to embrace, to make rational management decisions in an organizational context. So thank you one more time, and hope to see you as we continue studying leadership and management. Bye-bye.
Greetings to you all and welcome back to the lesson. Today we are continuing with the subject strategic management. We've been studying business strategies and models. We've covered the generic competitive strategies. Today we move to the interactive strategies. Now, in studying interactive strategies, we are going to consider the interactive price and quality strategies. Then there is the cooperative strategy and the game theory. But first of all, what do we mean by interactive strategies? Interactive, from the word interact, to interact. Interactive strategies refer to a competitive framework where a firm's strategic choices are made based on the anticipated actions and reactions of other market players. This is unlike the generic strategies which focus on internal positioning. We're done with part A and B. Let's move to part C of this question. Sunny Limited is analyzing two options on how to expand its operations. The following data relates to two options. So we have option A and option B. So we have fixed cost for option A, selling price per unit for option A and B, variable cost per unit for option A and B, the expected sales for option A and B. Then the next page reads, required, Roman 1, contribution margin per unit, 3 marks. Roman 2, the break-even point for both options, 3 marks. Roman 3, the operating income under both options. Number 4, we have advise Sunny Limited on which option is more favorable. Advise Sunny Limited on which option is more favorable. That is the question. So we are first of all to contribute the contribution. Part A of the question reads, contribution margin per unit. Contribution margin per unit. This is part C, contribution margin per unit. That is Roman 1. So we can have this thing in a table. We have contribution margin per unit. We can have the formula there. Contribution margin. There are two ways of answering this. I'm thinking of a better way that instead of just answering it straight away, you can have it. You can have this solution in form of a table. You can have it in form of a table. So we have the requirement here. For example, here we have contribution margin per unit. What is the formula? The formula of contribution margin per unit is selling price per unit minus variable cost per unit. That is the formula. So we have contribution margin for product A. Product A. Is it product A? Option A. It's called option A. Option A. And there is option A, option B. Selling price per unit. Contribution margin ratio is equal to selling price per unit minus variable cost per unit. For option A, the selling price is 150. The variable cost for option A is 90 shillings. And therefore, the contribution margin per unit is 60 shillings. Option B, the selling price per unit is 150 shillings. Variable cost per unit is 75 shillings. So 75 deducted from 150, this is equal to 75 shillings. Then Roman 2, what is required for Roman 2? Roman 2, we are to calculate the break-even point for both options in units. Okay. So break-even point in units. This is break-even point in units. The break-even point in units we know is equal to the fixed cost over contribution. Fixed cost over contribution margin. That is the formula for the break-even point in units. So from the question we read, option A, fixed cost is 200,000 shillings. This is 200,000 shillings. We divide by the contribution margin, which we calculated here, is 60. So I'll get my machine. 300,000 divided by 60. 200,000 divided by 60. This is equal to 3,333 units. Let's do the break-even point for option B. The break-even point for option B, the fixed cost option B is 280,000. 280,000 divided by the contribution here is 75. So I take my machine again and punch in 280,000 divide 75. So I'm getting here 3,000. This is 3,733 units. To break even, option A requires 3,333 units to break even. Break even is a point where profit is zero. So option A will break even when 3,333 units are produced. Option B will break even when 3,703 units are produced. Then Roman 3, the operating income under both options. Look at Roman 3, operating income. 3, operating, the operating income, how do we calculate the operating income? Look at the question. What information do we have? We have expected sales. So our operating income, we will determine it by using the expected sales. We'll multiply the contribution margin per unit times the expected sales, then we deduct the fixed costs. So the formula for operating income will be the contribution margin per unit times the expected sales, deduct fixed costs. This is contribution margin per unit times the expected sales. We have the expected sales in units. The expected sales we have from the question in units. We deduct the fixed cost. So the contribution for option A, we have it here. This is 60 shillings times expected sales. From the question, expected sales is 6,000 units. The company is expected to sell 6,000 units. This will give us the contribution. Then we deduct the fixed cost for the option A, which is 200,000. 200. How much is it? This is 60 times 6,000. 200,000. This gives me how much? 60 times 6,000. This gives me, how much is this? The expected sales is 6,000. So let me take it again. 60 times 6,000. What is the fixed cost? The fixed cost is 200,000. The fixed cost is 200,000. Fixed cost is 200,000, which is equal to, this gives me 160,000. That is the operating income for option A. For option B, the contribution is 75. The company is expected to sell again 6,000 units. That is the total contribution. We deduct fixed cost of 280,000. So I have 75 times 6,000 minus 280,000. So this is equal to 170. Operating income, option A, 160,000, option B, 170,000. I'm moving on well. Are you following, candidates? You need to memorize the formula. For you to be able to answer such a question, you have to have this formula in your head. Formula for contribution margin, formula for break-even point, is a formula for operating income. Operating income, we take the contribution margin per unit, we multiply by the number of units. For option A, 6,000, option B, 6,000, we get the total, then we deduct this cost to arrive at the operating income. Then what else is required from this question? Roman 4, advise the company on which option is more favorable and why. Definitely option B is more favorable. Number 4, option B is more favorable because it has, or it promises, a higher operating income of shillings 170,000. You see, this one is higher than the 160,000 because companies are in business to make more income. If option A promises 170,000 shillings, option B promises 160,000 shillings, it's better to take the one that promises a higher operating income. So that is it, candidates, for today's lesson, in which you have answered the question that was tested in August 2025, question 4. We will continue to provide more solutions to these questions. If you have any queries, feel free to ask your questions, and all your questions will be answered. Bye-bye. Hello and welcome to the lesson. The subject is business and data analytics. Today we are going to study the various types of data analytics. By the end of this lesson, you should be able to explain at least 3 types of data analytics. Types of data analytics. Types of data analytics. Data analytics, learners, is a broad field, and there are 4 main types of data analytics. There are 4 main types of data analytics. Number 1 is known as descriptive analytics. Number 2, diagnostic analytics. 3, predictive analytics. 4, prescriptive analytics. 4 types. Descriptive analytics, diagnostic analytics, predictive analytics, and prescriptive analytics. Now, each type here has a different goal and a different place in the data analytics process. Descriptive analytics is the first one. Descriptive analytics helps answer questions about what happened. Answer questions about what happened. What happened. And the techniques here summarize large data sets to describe outcomes to the stakeholders. And by developing the key performance indicators, all right, the strategies can help track successes or failures. And we may also have specialized metrics that are help to track the successes or the failures in an industry. We could have metrics such as return on investment, which is used in many industries, and so on. So the process here requires the collection of relevant data. Here it requires the collection of the relevant data, the processing of the data, data analysis, as well as data visualization. And the process here provides essential insight into the past performance.
because data analytics answers the question, what happened? It looks into the past, the history, what happened in the past, what is the past performance, and so on. So descriptive analytics looks into the history, into the past, what happened. The second type of data analytics is diagnostic analytics. And here, diagnostic analytics helps answer the questions about why things happened. Why things happened. This is what happened. Diagnostic answers the question, why things happened. And the techniques here supplement more basic descriptive analytics. They take the findings from the descriptive analysis and digs deeper into the cause of what happened. And the performance indicators are further investigated to discover why they got better, why things got better, why things got worse, and so on. And there are various steps in the diagnostic analytics. The first step being the identification of anomalies in the data. And the anomalies may be the unexpected changes in a metric or a particular market. The second step in the diagnostic analytics is the collection of relevant data. Collection of relevant or related data. This is data that is related to the anomalies. Okay? So first of all, I've said the first step in the diagnostic analytics is to identify anomalies in the data. Then number two, data that is related to the anomalies is collected. Identify anomalies in the data, then collect data related to the anomalies in the data. Then after that, statistical techniques are used to find relationships, to find trends that explain the anomalies. That is diagnostic analytics. I repeat, identify anomalies, step number one. Step number two, collect data related to the anomalies. Then number three, use statistical techniques to find relationships, to find trends that explain the anomalies or the cause of the anomalies. Let me put that down. One, identify anomalies in the data. Two, collect data related to anomalies. Three, use techniques to do what? To identify the, or to find relationships, to find trends that explain the anomalies. Use mathematical or statistical techniques to find relationships and trends in the anomalies. The third type of data analytics is predictive analytics.
Predictive analytics, on the other hand, helps answer the question, what will happen in the future? Predictive analytics helps answer the question, what will happen in the future? And the techniques, the techniques here use historical data to identify trends, then determine if they are likely to recur. The predictive analytical tools provide valuable insight into what may happen in the future, and its techniques include variety of statistical as well as the machine learning techniques, such as the neural networks, the decision trees, the regression, and so on. So based on historical data, the predictive analytical tools can help the firm answer the question, what will happen in the future, by looking at trends in the historical data, the past performance. Predictive analytics, from the word predict. These tools may help a company to answer the question, what will happen in the future? Tools such as regression, machine learning, and so on. Do you understand? Yeah, that is pretty clear. Predictive analytics. Then the last type of data analytics is prescriptive analytics. Prescriptive analytics helps answer the questions about what should be done. What should be done? What should be done? Prescriptive analysis helps answer the questions about what should be done. What should be done. And by using insights from the predictive analytics, data-driven decisions can be made. Data-driven decisions can be made. Based on predictive analytics, data-driven decisions can be made. And that allows businesses to make informed decisions in face of uncertainty. And candidates, prescriptive analytics techniques rely on machine learning strategies that can find patterns in large data sets. Patterns in large data sets. And by analyzing past decisions, by analyzing past events, the likelihood of different outcomes can be estimated. All right? Prescriptive analytics help answer the question, what should be done? This type of data analytics provide insights about insights that businesses need to make effective and efficient decisions. They provide insight that businesses need to make effective and efficient decisions. So these are 4 types of data analytics. We've said data analytics is a broad field. We've briefly described 4 types of data analytics. The first one being descriptive analytics, which we've said answers the question, what happened? Diagnostic analytics answers the question, why things happened. Number 3, predictive analytics answers the question,
what will happen in the future. And lastly, prescriptive analytics helps answer the question, what should be done about what should be done by using insights from predictive analytics. We've said also that data-driven decisions can be made, data-driven decisions, because the decisions are based on past data, on past big data. So these are 4 types of data analytics: descriptive analytics, diagnostic analytics, predictive analytics, prescriptive analytics. Here is your today's assignment. Explain 4 types of data analytics, and when doing the assignment, make sure your notes, you don't make reference to notes, you don't make reference to videos. Try and see if you can recall what you have learned from your memory. Thank you. Bye bye.
So let's move to non-adjusting events. This is another type, non-adjusting events. Non-adjusting events. Non-adjusting events, these are disclosures. These are new events that did not exist prior to the audit period. These relate to conditions that arose after the audit period. These are conditions that arise after the audit period. They do not change the 2025 score, but they are so material that they must be disclosed to ensure the report is not misleading. One example could be board resignations. Say 40% of the board members have resigned. Sudden resignation of, say, 40% of the board. For example, the chair has resigned, the audit committee lead has resigned in January, immediately after the audit, or March or February. Now, while the 2025 board was stable, the 2026 board is now in a governance crisis. When you are auditing this company in 2025, the board was intact. But in February, 40% of the board members have resigned. So that is a non-adjusting event. This is an event that is arising after the audit period. It may not change the 2025 score, but is a serious matter that needs to be disclosed so that those who are relying on the 2025 report are not misled. Mergers and acquisitions. Mergers and acquisition. It is a merger or the company has acquired another company. Signing a deal to be acquired by a foreign entity 2 weeks, say, after the year 2025 audit period, that significantly changes the organization's stakeholder landscape. It is an event that did not exist in 2025, but in 2026, that is the position. We have merger or so that is another non-adjusting event. It could be major disaster. Major disasters could be a fire outbreak that demolishes the entire server room, a fire or a cyber attack in February 2026 that destroys the company's primary data center, and that tests the business continuity plan and must be disclosed as a significant risk to governance in future. It has to be disclosed. Example for new legislation. These are examples of candidates of non-adjusting event. There's a new legislation, for example, the enactment of a new law, or it could be change in a company, the Companies Act. So that did not exist in 2025, but that happens after 2025, say in February 2026. a new legislation that makes previous best practices now mandatory requirements. We are new provisions that did not exist in 2025, but because of the new law, what was regarded as best practice now becomes mandatory requirement. So that's it, candidates, for the types. We are discussing post-governance and compliance audit, the adjusting and non-adjusting events. This is just to reinforce what we did in our last session.
Hello learners, welcome today to session 3 or lesson 3 where we want to look at long-run analysis of costs. Long-run analysis of costs. Long-run analysis of costs. So in the short run, we said that this is normally a period where at least one factor must be fixed and the other should be variable. In the long run is where all factors can be varied, and therefore we do not have any like law of diminishing returns to variable factor, because we are assuming that all factors can be varied. Varied meaning we can interchangeably vary the proportions of different factors. Why? Because they will not remain constant, as in the case of short-run analysis. So what operates in the long run is the economies or these economies of scale. So when the firm factors can be varied, the firm can either experience economies of scale or diseconomies of scale. So in this lesson, we want to look at economies of scale in relation to internal economies of scale. So what are economies of scale? Economies of scale are simply those advantages that a firm enjoys after it has expanded. We normally have what we refer to as an optimal size of a firm. And an optimal size of a firm is simply that efficient size that a firm can have so that it's able to produce at the minimum or the lowest production cost per unit, so that it has no option of either increasing or decreasing its level of output. So in that case, we say that the firm is operating at its optimal size. And that's when economies of scale will come in. So in economies of scale, we want to begin with internal economies of scale. So what are internal economies of scale? These are those benefits, or I refer to them as advantages, that a firm can experience that are coming from within. They have nothing to do with the outside. What are the happenings that are happening in the organization, like when the firm has expanded, that can be a benefit to the firm? That's what we refer to as internal economies of scale. So they are as follows. We have what we refer to as technical economies of scale. So technical economies of scale, like when a firm increases in its size, it is normally able to use sophisticated or modern technology. And when it is using modern technology, it will be able to increase its level of output than that firm that has not expanded. And under technical economies of scale, we have such benefits like what we refer to as indivisibilities. So what are indivisibilities? Indivisibility is simply where a firm is able to take advantage of a process that cannot be reproduced on small scale. So one of the technical economies that a farm will enjoy is what we refer to as indivisibilities. And indivisibility is simply where a farm is able to take advantage of a particular process that cannot be reproduced on small scale. So that simply means this farm will have a process or a particular process which a small farm cannot have. Like for example, when a farm has a particular machine that can enable it to produce, and when it is producing to in large scale or in large quantities which a small farm cannot be able to produce. Why? Because a small farm produces on small scale. We say it is enjoying benefit of indivisibility. We have another one which we refer to as increased dimension. Increased dimension increased dimension is where a farm can increase its equipment, can increase the capacity of its equipment so that it is able to produce a larger output without increasing costs. That is increasing without increasing production costs. So increased dimension is where when a farm has a particular equipment, it can decide to enlarge or to increase the capacity of that equipment so that it's able to produce a larger output than what it has been producing before without necessarily increasing the production cost. I can give an example like for these commercial services, you've been having or owning a matatu. A matatu has one driver, and then because your business has enlarged, you now decide to bring in a bus. So a bus still will need one driver, but the capacity is more large than that of a matatu. So in that case, that benefit is called increased what? Dimension. You are producing more, but you are not necessarily increasing the production cost. And if it is there, then it is very minimal. And then number 3, Roman 3, still part of technical economies of scale, we have another benefit of linked processes. So linked processes is simply where a farm can link up its processes that can enable it minimize its costs. So linked processes is where, like, we have farms that buy raw materials, and once they buy those raw materials, they use the raw materials in the production of goods and services. And then once they have produced goods and services, they again market for those goods and services before they are sold. So linked processes is simply where a farm can decide to supply for itself raw materials as well as produce the goods. It can even go up and do the marketing by itself so that it is reducing costs such as fuel cost. You don't need to get raw materials from another supplier, bring them before you produce. You simply have a portion where you are supplying raw materials So instead of buying them from outside, you simply use what you already have, and then you will be able to do what? To produce using minimal costs. Why minimal costs? Because we will cut costs to do with transportation, etc. Those are called linked processes. And then we also have another one still on technical economics called specialization. Specialization. So specialization can be where a farm can specialize, like in terms of machinery and labor, so that it produces what's quality, so that it produces what is quality. So specialization is where a farm can simply decide like to specialize on a particular machine. So it buys a special machine that will enable you to produce what is quality, or have a specific class of workers who are able to help in production of that which is quality. So like when we talk of competition, what happens? Because they will be producing what is quality, their products will be more competitive than of those other farms. And then we can also talk about research, still under technical economies. Research is like when a farm has grown, it has an ability of conducting a market research. Like whenever it wants to introduce a new good or a new product, it can be able to know what are the needs, what are the tastes and preferences of the people before it can design and produce what is to satisfy the need of its customers, which may not be so with small farms. So research is where a farm will be in position to conduct a market research, which can enable it to produce that which satisfies its customers. And when that happens, that means profitability of the farm will increase. When customers are satisfied with what you produce, they will buy more, and when the more they buy, the more you'll do what? The more you will make profit. That was number one. Then number two, we have what we refer to as financial economies. So financial economies is where when the farm grows or enlarges, it normally has more in terms of assets. And for example, whenever it wants to raise like a loan or funds from a financial institution, it is in proper position to provide security or what we refer to as collateral. And because of that, they will always raise funds at a lower rate, like in terms of interest, than those that are small farms. So financial economies is where a farm is able to raise funds from financial institutions at a lower cost. Why? Because at a lower cost, because it is in position to raise assets that can be used as collateral. that can be used as collateral. Then number 3, we have marketing economies. Marketing economies. So marketing economies is where when a farm expands, it will be able to like take advantage in buying in bulk. When a farm buys in bulk, it will enjoy quantity discounts. And when it enjoys quantity discounts, it means that it will be buying at a lower cost than what others will be buying at. And therefore, it will be always saving in terms of purchase. And then it can also enjoy economies to do with packaging. When it is packaging in large quantities, it is more cheaper than when packaging in small quantities. And then when it comes to selling and even distribution, it will have that advantage. So marketing economies, these are normally in the form of like buying in bulk. This enables the farm to take advantage of quantity discounts. Hence buying at a lower price, which makes them to save in terms of the purchase price. We also have packaging. Packaging is where I can just say packaging in large quantities. Packaging in large quantities enables a farm to save rather than packing in small. Why? Because when we pack in large quantities, the cost is normally spread on those units that are packaged in that one package. But when you are packaging in small quantities, then that simply means that you will incur a higher cost than a farm that is packaging in large quantities. And then number 4, we have diversification. Diversification is where when a farm enlarges, it has an ability of even producing more products. Like it can introduce new products. Why? Because it has an ability to do that. So like, for example, where there is competition or when it is facing competition with other farms, it can decide to introduce new products which can enable it to fight that competition, and that enables it to continue remaining on the market. So diversification is simply where a farm is in position to introduce new products. A farm is in position to introduce new products that can lead to increased profits, as well as acting as a risk management strategy. And then number 5, we have risk-bearing economies. So what are risk-bearing economies? Like when a farm expands, it can be able to predict risks better than small farms. Why? Because like when it is conducting a market research, it will be able to know what are the advantages, what are the disadvantages of its product, who are the competitors, and because of that, it can simply be able to use SWOT analysis so that it is able to do what? To minimize its risks than a small farm. So risk-bearing economies, we say that a large farm is able to predict risks than a small firm. Why? It has an ability to conduct a market research. It can conduct a SWOT analysis than a small firm. So those are the internal economies of scale. Then we have disadvantages or these internal diseconomies. Can look at that shortly. Internal diseconomies of scale. So in our next lesson, we'll be looking at internal diseconomies of scale. So learners, have a good day. This ends or marks the end of our session.
I greet you all and welcome you back to the Manifested e-learning platform. The subject is meetings, compliance, and administration. The topic is governance, standards, and guidelines. Today we are moving to the governance on the governance standard number 005. Governance standard number 005, which is on board papers. In this lesson, we will be studying the characteristics of effective board papers and what are the requirements. What are the requirements for the preparation of board papers? Because candidates, board papers governs the quality, the delivery, and also the life cycle of information that is provided to the directors. The management is required to provide certain information to the directors before they hold their meetings. And if the board is the brain of the company, then we can say board papers are the fuel. And the standard 005 ensures that directors aren't just receiving data, but they are receiving actionable intelligence. If you are a director of a company, then you need to receive actionable intelligence from the management for you to be able to make informed decisions. So the standard sets the expectations for the management team to provide high quality information that enables informed decision making. Understand, candidates? Because it is the management team that is tasked with the responsibility of ensuring that the company records are properly kept, like the financial statements, like information on the day-to-day operations of the business. The management team may have information on marketing, on risk management, they may have information on production, on human resource, and all that. And we know when the directors meet, they have to make certain resolutions. They have to give direction on what the strategy of the company should be, and they need proper information. So that's why we have a standard called Governance Standard 005 on board paper. This standard sets expectations for management to provide high quality information that enables informed decision making by the board of directors. So what are the characteristics of effective board papers? Characteristics. Let's begin with the characteristics. What are the characteristics of effective board papers? Now, the first point is that the board papers must be, one, concise. To meet the GS005 standard, board papers must be concise. They must be concise. That means they should avoid data dumping. It should not be too detailed, but the board papers should provide summaries and key highlights. That's the first characteristic. Number two, clear. Board papers are required to be clear. That means the management should use plain language and avoid internal jargon. It must be clear in clear English that can be understood by everyone. The next characteristic of board papers is correct. These papers should be accurate. The information contained in the papers should be factually accurate with verified data. Or complete. Complete. It should include both the pros and cons. All right, both the pros and cons, the advantages and risks of a proposal. If it is a proposal, if the management is making a proposal to the board, then that proposal must have both the merits and also the risks. It has to be complete. Then we have contemporary. Contemporary. The board papers should provide early enough, be provided early enough to be read, but recent enough also to be relevant. Contemporary means it should not be outdated information. It should be recent. Contemporary means recent information. Understand? Provided early enough to be read, because if you are not providing information early enough to be read, you may provide information, but the directors may not have time to read it. It should be early enough, but also recent enough to be relevant. So these are the 5 C's. These are the 5 C's. To meet the GS 005 standard, board papers must adhere to the 5 C's. Must adhere to the 5 C's. These are the 5 C's. C, C, C. C, C, C. C, 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 C. C, 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 C. C, 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 C. 5 C's. Concise, clear, correct, complete, contemporary. Concise, clear, correct, complete, contemporary. Concise, clear, correct, complete, contemporary. Okay? Is that clear, candidates? Yes, that is clear. Now, that's the first thing we are discussing in this lesson. The second thing we are discussing here is the standard structure of a board paper. What is the standard structure? What is the anatomy? What is the standard structure? Number 2, standard structure. Standard. What is the standard structure of board papers? Standard structure of board papers. Now, candidates, a professional board paper typically follows a uniform template so that directors know exactly where to find information. So there is a structure, there is an anatomy of board papers. So one section of the board paper should be, board paper should have a section on the purpose of the board paper. Are you following? Yes, purpose. So let's have purpose and then description. So an effective, a professionally prepared board paper follows a uniform template. And in that template, there has to be a section for the purpose of the board paper. This is a purpose it is for this decision, for discussion or information. We may have a board paper for decision, for discussions, or for information. Is this for decision, for discussion, or information? When the management submits a board paper to the board paper must have a purpose. Is it the purpose, is a board paper's purpose for a decision, or is it just for purpose of discussion, or is it a paper that just provides information? Then there is executive summary. Executive summary. Executive summary. A board paper must have an executive summary. This is just an adumbration of the entire board paper. It's just a one-page overview for quick digestion. Executive summary is just a one-page overview. One-page overview for quick digestion. A board paper, if it is too lengthy, then it must have an executive summary, just a one-page overview of the entire board paper for quick digestion, so that someone who may not have time to read the whole of it should be able to read the one page and understand what the board paper is all about. Strategic alignment. Board paper should have a section for strategic alignment. Strategic alignment, candidates, is also very important. That is how the item fits the company's long-term goals. How the item fits the company's long-term goal. A board paper should contain a section that explains how the board paper fits into the company's long-term vision or goal. We are describing, candidates, the standard structure of a board paper. Must have a purpose. There's a section for executive summary, and there is a section for strategic alignment. Another section is financial impact. Financial impacts. A board paper should contain a section that explains the financial impact of that board paper, like budget requirements, return on investment, cost-benefit analysis, and so on. Budget requirements. How much budget is needed? If it is a proposal, if the management team is presenting a proposal in form of a board paper, then that board paper, that proposal must have budget requirements. What are the budget requirements? It should also have what we call return on investment. What is the return on investment if it is a proposal? Or even the cost-benefit analysis or cost-benefit analysis. Financial impact. Still on standard structure of a board paper, another section is risk assessment. Risk assessment. Risk assessment. Another key section of a board paper, risk assessment. risk assessment. What could go wrong and how will it be managed? What could go wrong? This section describes what could go wrong and how it could be managed or mitigated. If the management is submitting a proposal to the board, then there has to be a section on risk assessment which describes what could go wrong, what are the risks, and how could these risks be mitigated or managed. Then lastly, we have a section on recommendation. There must be a section on recommendation. Now, recommendation is the specific action management wants the board to take. Specific action, they must recommend specific action that management wants the board to take. A specific action that the management wants the board to take. Because candidates, you need to understand that the management has a limitation on what can be done. The management may know what is supposed to be done, but they may not have the authority to do it. So the management may be required to present a proposal to the board in form of a board paper, and it has to have these sections. What is the purpose of the board paper? The board paper should have an executive summary, a one-page overview for quick digestion. The board paper should contain a strategic alignment. That means how the item fits into the company's long-term goal. They have to explain. Then there has to be a financial impact. If it is a proposal, what is the budget for implementing that proposal? What is the return on investment for implementing that proposal? And it should also contain cost-benefit analysis. What are the costs and what are the benefits? Does the benefits outweigh the costs? That has to be part of the proposal. Then there's a section for risk assessment. This assessment, these are just identification of the expected risks. Because if you're undertaking a project or anything else, there has to be risks that are associated with that proposal. Then it should also indicate how the risk could be mitigated. Then lastly, there is a recommendation, the specific action that management wants the board to take. So this is the standard structure of board papers. Standard structure of board papers. Do you understand, candidates? Yes. Now, having discussed the characteristics of board papers as per the governance standard number 005 and the anatomy or the standard structure of board papers, we now move to the third section of our today's lesson on the timeliness rule. Number 3, the timeliness rule. The timeliness rule. Now, one of the most critical aspects of GS005, one of the most critical aspects of this standard, governance standard number 005, is the lead time. The lead time, candidates. Lead time. And in most cases, the lead time is a 7-day rule. Most governance standards mandate that board packs be distributed at least 7 calendar days before the meeting. The board, according to this standard, should receive, the board members are required to receive this board papers from management at least 7 calendar days before the meeting is held. That is the lead time. That is the timeliness rule. Understand? Yes. 7-day rule. There is the number 1. 7-day rule. I've explained that the papers should be distributed to the board of directors at least 7 days before the meeting. Then there is the late protocol. The last paper protocol is called the late paper protocol. The late paper protocol. Still on the timeliness, there is the late paper protocol. The late paper protocol. Late papers should be the exception and not the rule, and it often requires the chairman's explicit permission to be tabled. If a paper is not submitted within the 7-day rule, then it has to follow a certain protocol. It cannot be presented to the board unless the chairman tables it. Requires the explicit tabling by the chairperson. You understand, candidates? There are certain times when a paper may delay. We are calling it late paper. Maybe it is submitted in 2 days to the meeting, 1 day to the meeting, 3 days to the meeting. Understand? Yes. That is the timeliness rule. Then in closing this lesson, it's important for us to consider the security and retention of board papers. Security and retention. Security and retention. Very important. Board papers contain the company's most sensitive secrets. Okay? These are very confidential, secretive company documents. And therefore, there has to be guidelines on security and retention of board papers. And that has not been left out by the governance standard 005. So what are the provisions? One is digital portal. The move from paper toward secure encrypted board portals. That is the trend. We have digital portals. Digital portals. Moving away from paper toward encrypted board portals. That is one way to safely keep board papers. Instead of having them in physical files, they can be stored digitally. Number 2, confidentiality. Confidentiality. Directors must delete or return papers after the meeting, or store them in a secure locked environment. Understand? Yes. That is one way to secure and retain board paper. There is also the aspect of access rights. Access rights. Access rights. By access rights, we mean after discussions of the board, the management should only be allowed to access what is relevant to them, while directors have full access. So the management does not have full access to what is discussed by the board. That is very important. Management should only see what is relevant to them. Management should only see what is relevant to them, but the directors can have full access. The directors must have full access to the board papers. But there are times when there is what we call information asymmetry. There are times when these rules are not adhered to, may lead to information asymmetry. Information asymmetry. When the governance standard 005 is not properly executed or followed by a company, it may lead to information asymmetry. This is where the management has full information, but the board has limited information. When management knows everything and the board knows very little, that may lead to information asymmetry, which may lead to a struggling board. The board struggles a lot to get information and they may not execute the mandate effectively. And that is why the GS005 comes in to bridge that gap, to help the directors have full information and the management to have access to what is only relevant to them. The GS005 is designed to bridge that gap so that the board does not struggle as a result of information asymmetry. So that's the end of our today's lesson on Governance Standard 005 on board papers. If you have any question, please feel free to ask. Our lines are open, and any question that you send will be answered. Over and above these video lectures, we have prepared exam forecast books for you. We have the study text, which contain full information covering the entire syllabus. Then we have Kasneb past paper examination questions and answers revision kits, which are available in our physical shops. They are available in bookshops. You can also write to us. We deliver the books to you directly. Thank you. God bless you. Bye-bye.
Simulation is a quantitative method of analyzing uncertainty. Simulation is a quantitative technique of analyzing what? Uncertainty. And with simulation here, there are some basic requirements that you must be provided for. For you to be able to simulate, so these are the requirements that you must have in a question. Number one is a probability distribution. You must be given the probability what? Distribution of each variable you want to simulate. Of each variable. That is the first thing you must have. So if you want to simulate sales, they must give you probability distribution of what? Sales. If you want to simulate the quantity, they must give you what? The quantity. Number two, you must also determine your cumulative probabilities. You must determine your cumulative probabilities of each variable. The cumulative probabilities of each variable. Once you have the probability, you can now determine your cumulative probability by adding. The third item you want to have is you're going to get your random number ranges. Your random number who? Ranges. Show you that. Then number 5 is you must also have your who? Random numbers. Random numbers here basically are numbers assigned that show equal chance. They are numbers assigned that show equal chance of occurrence. So random numbers. Once you have determined your random numbers, or once you've been given your random numbers, this case in an exam situation, they will always provide the random numbers. Number 5 is you set up your simulation worksheet. Your simulation worksheet. You must set up your simulation worksheet where you're going to simulate your information. Those are the requirements that are required for us to be able to carry out what? Relation simulation. So I want us to go to a question. Let's go to December of 2022. December 2022. Question 2A. Question 2A. December of 2022. Question 2A. They are saying, Lengo Limited is considering marketing a new product. The fixed cost of this product will amount to 5 million. There are 3 uncertain factors, namely selling price, variable cost, and annual sales volume. Selling price is for 400, for 50, and 500, with a probability of 0.3, 0.5, and 0.2 respectively. Variable cost is 200, 250, and 300, with a probability of 0.1, 0.6, and 0.3. Your annual sales volume in units is 40,000, 50,000, and 60,000, with a probability of 0.4, 0.5, and 0.1. Additional information. Assume that the 3 factors are statistically independent. The company uses cost, volume, profit analysis to make decisions. The following random numbers are provided. You have your selling price with a random number of 8, 0, 6, 1, 3, 5, 1, 3, 9, and 1. The variable cost, the random numbers are 0, 4, 3, 4, 6, 7, 2, 8, 5, and 9. So let me repeat the variable cost random numbers: 0, 4, 3, 4, 6, 7, 2, 8, 5, and 9. The sales volumes had the following random numbers: 6, 3, 9, 4, 0, 9, 7, 6, 8, and 5. Required. Using CVP analysis criteria, simulate the problem and determine the average what? Profits. Simulate the problem and determine the average what? Profits. Number 1. For us to do this question, we must confirm what we've been given. Have we been given the probability distribution of each variable? Yes, we have been given. So, come here and get the selling price. We have the selling price. You have the shillings, the selling price in shillings: 400, 450, and 500. Your probability, which I denote as P0, is 0.3, 0.5, and 0.2. Let's get our cumulative probability. Let's determine our cumulative probability. This is 0.3. 0.3 plus 0.5 is 0.8, and that is 1.0. The next variable that we have probability is variable cost. So remember, all these uncertain items, you must be given probability. You must be given what? Probability. Your variable cost is 200 with a probability of 0.1, 250 with a probability of 0.6, 300 with a probability of 0.3, 0.3. So that now your cumulative probability is 0.1, 0.7, and that is 1.0. That is for who? For variable costs. The third item that we have our probability distribution is your sales volumes in units. In units, the units are 40,000, 50,000, and what? 60,000. Your probabilities 0.4, 0.5, and 0.1. We need to determine our cumulative probabilities. 0.4, 0.9, and that is 1.0. 1.0. Right. So what we have effectively done is we have the probability distribution. Then using the probability of each variable, we have determined our cumulative probabilities. Our cumulative probabilities. That is in order. All right. Once we have done that, we then need to determine our random number what? Ranges. Our random number ranges. So let me come back here. Computation of random number ranges. So let's again start with selling price. 400, 450, 500. Your probabilities 0.3, 0.5, 0.2. Your cumulative probabilities 0.3, 0.8, and 1.0. Then your random number ranges, I'm just going to write them there. Your random number ranges there. Now your random number ranges will be between 0 and 2. So we normally say when you're determining random number ranges, the ranges should be inclusive. They should be inclusive, such that if you start between 0.2, then the next observation should be between 3 and 7. Then the next one is between 8 and 9. 8 and 9. Okay? That is the selling price. Let me go to what? Variable cost. Some of these items I am repeating, which is also in what? Shillings, probability, cumulative probability, and random number what? Ranges. $200, $250, and $300. Probability is 0.1, 0.6, 0.3, 0.1, 0.7, and 1.0. The random number ranges now will be between 0 and 0. Why? Because we've said it must be exclusive. It must be inclusive. It must be inclusive. Then 1 to 6, 7 to 9 must be inclusive. That is your variable cost. Let's now finalize determining the random number for sales volume. Cumulative probabilities 40,000, 50,000, and 60,000. 0.4, 0.5, 0.1, 0.9 and 1.0. Then we must determine our random number what? Ranges. So this is 0 to 3, 4 to 8, 9 to just 9. Summer 9 or 9 to 9, no problem. 9 to 9 there. So remember, what guides us when you're getting the random number ranges? Number one is the decimal point. So if we had two decimal points here, for example 0.30, I would have written my random number ranges in tens, not ones. Here they are in ones because the decimal place is in one place. So if they are more than what? One decimal place, if it is more than one decimal place, I will also have the random number more than once. More than once. So let me adjust that. Right. That is wonderful. Let's now prepare our simulation worksheet. Our simulation worksheet. Okay. We have already been provided the random numbers, so that we have. So we want now to prepare our simulation worksheet. When you're preparing this simulation worksheet of CVP, you're going to prepare it according to what is being asked in the question. And here they are telling us required, simulate the problem and determine the average what? Profits. How do we get your profits? You say it is P minus V by the units minus your who? Fixed costs. Minus your fixed cost. So this is how your simulation worksheet should look like here. Okay. So the first item should be your selling price. But because selling price you've been given random numbers and the probabilities, so because it was uncertain, we will come here and write the random numbers and your selling price P. There. The variable cost, we did also being provided the variable cost, their probabilities and random numbers. So again we introduce random numbers for variable cost and who? And the variable cost there. Then your random number for the units you want to do what? To sell, for the units Q. For your units. Then we know, or we can first determine our contribution margin. Let's first determine our contribution margin CM, which is given by P minus V. So this is not fully a requirement, but let's just determine it. If you're able to just compute directly, well and good, but let me show you that so that we simplify our work and we look more organized. We look more organized. Okay, so that is P minus V, contribution margin. Let's get the random numbers for your units. For your units. For your units. Then we get our total contribution and your fixed costs. And then lastly your who? Profit. Lastly your profit. We can even try squeezing this. Try left so much spacing. So we can readjust this. I'm just rewriting this so that it is better off for you. It is better off for the students to see. And fixed cost, and then your profit, and then your profit. All right, that is how a simulation worksheet of CVP should look like. The first random number of selling price is 8. And with the selling price of 8, or rather with a random number of 8, your selling price is between 8 and 9. The random number, you normally read it according to the random numbers. So you go to your selling price, and where you have a random number of 8 and 9 is at a selling price of how much? 500. So here you're going to write what? 500. Then variable costs random number is 0. Your variable cost with the random number, when your random numbers are 0, your variable cost is 200. Then your contribution margin will be 300. Why? 500 minus 200. The next random number of sales volume is 6. And with the sales volume of 6, of random number 6, your units should be 50,000. Then to determine our total contribution, you're going to take your contribution margin by your units. So I believe that is 150 or 15. 1, 2, 3, 4, 5. Your fixed cost was 5 million. Fixed cost was 5 million. Then you get your what? Profit. Then you get your what? Profit. Is that a profit of 10 million? That is a profit of what? 10 million, All right. The next random number is 0. So allow me to just write these, all of them together. 0, 4, and 3. With the price of 400. Why? Because with the selling price of 450 actually, because your random number is between 3 and 7, So 450. Let me see. Yeah. Your random number is 0. So your selling price is 400. Don't get this confused here. 400. With a random number of 4, your variable cost is 250. So your contribution margin is 150. With a random number of 3, you're selling how many units? 40,000. Okay, we'll come back to the contribution. Then 6, 3, 9, 1, 4, 4. Just highlighting the random numbers now. 3, 6, 0, 5, 7, 9, 1, 2, 7, 3, 8, 6, 9, 5, 8, 1, 9, 5. All right. The random number of 6, your selling price is 450. 1 is 400. 3 is 450. 5 is 450. 1 is 400. 3 is 450. 9 is 500. 1 is 400. Variable cost of 3 is 250. 4, 250. 6, 250. 7, 300. 250. 8 is 300. 250. 300. So remember, what is guiding us is our ranges. The quantity, 9 is 60,000. 4 is 50,000. 0 must be 40,000. 60,000. 7 is 50,000. 6 is 50,000. 50,000. And lastly 50,000. This is 200. 150, 200, 150, 150, 150, 250, 100. Then what do we do now? We get our total contribution, 150 by 40 million, 40,000, that is 6 million. Your fixed cost is 5 million, 250, 200, 200 by 60,000, this is 12 million, that is still 5 million, so that should be 7 million, 7.5 million, 5 million, 2.5 million, this is 8 million, 5 million, if fixed cost is not changing, 3 million, 9 million, 5 million, 4 million, 7.5, 5 million, 2.5, 7.5 million, 5 million, 2.5. So remember, your total contribution is contribution margin by the units. Please don't forget. That is why 300 by 50 is that. What have you? 250 by 50,000 must be 12.5. And is 5 million, 7.5. This is 5 million. Then we get our profits. Let's get our profits. We simply add these profits. Plus 2.5 plus 2.5 plus 7.5. Is that 40 million? So therefore your average profit, remember in the question they are asking for average what? Profit. Going to take 40 million, divide by the number of times you've simulated. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 4 million is your average profit. 4 million is your average profit. And that's how we simulate what? CVP. That is how we simulate CVP. All right, I hope that has been properly understood, such that if it comes to question, you will be able to do what? To handle it. So the remaining items is sensitivity, statistical analysis, probability tree diagram, and continuous or normal distribution. Continuous or normal distribution. All right. Now, we're going to cover these next items during the next what? Session. During the next session. So from me, I wish you the very best and see you in the next session. Goodbye.
Most welcome learners to our lesson today. We are looking at public sector governance, policy and administration. In our lesson today, we are going to focus on administrative processes as part of administrative theory. In an organization, administrative processes comprise those particular tasks which are associated with the office that are required to ensure that an organization is operating efficiently. And when it comes to the area of public administration, there are certain generic administrative processes that we want to look at Then we have a look at the scope of public administration. Then we see what Luther Gulick brought out as the acronym of public administration in terms of its scope, and ultimately we will have a look at the importance of public administration. So when we look at administrative processes, as we have indicated, administrative processes are the office tasks, that are required to keep an organization operating. These particular office staff or office processes will be associated with receiving information, processing information, storing information, retrieving information, among other things that make a bureaucracy or an office administration run. And when specifically it comes to public administration has certain generic administrative functions and or processes which it has to go through to ensure that objectives are realized as set out. And one of the functions are policy making. And when it comes to policy making, these ones are the frameworks that are put in place to be able to achieve certain ends. Then you have organizing, which is in relation to grouping functions that are related together, ensuring that they are connected properly and they are staffed adequately, as we shall be seeing. Then when it comes to financing, this is the supporting the activities that have been planned and have been organized to ensure that revenue and resources are available to be able to finance them or to be able to meet the costs associated with those functions. Then personnel provision and utilization. This has to do with attracting, recruiting, selecting, and retaining the appropriate human resources that can be able to be tasked with the responsibility of a realization of the public administrative tasks or duties. Then when it comes to determination of work procedures, this has to do with making a decision in terms of the work that has to be realized or who is supposed to be deployed in those areas, what kind of processes are involved in terms of the field, in terms of the office, and ultimately the sixth generic administrative function or process in public administration is control, to ensure that things are on course in relation to what an organization intends to achieve. So these six generic administrative processes or functions, which are 1, policy making, 2, organizing, 3, financing, 4, personnel provision and utilization, 5, determination of work procedures, 6, control. Then give us what is referred to as the scope of public administration. So when we look at the scope of public administration, scope of public administration, scope of public administration. One of the authors or thinkers in the area of public administration by the name Luther Gulick, came up with an acronym, and this acronym has been used to capture or to sum up the scope of public administration. So Luther Gulick brought out an acronym, and this acronym is POSTCOB. And each letter in this acronym stands for a given word, so that you have each letter, and then there's the 2 here. You have a P, which stands for planning. Then you have O, which stands for organizing. Then you have S, which stands for staffing. Then you have D, which stands for directing. CO stands for coordinating. R stands for reporting. And B stands for budgeting. So those terms that were given by that term that was given by Luther Gulick gives us a summary or captures the scope of public administration. So we can have a look at this briefly. So when you talk about planning, so planning is concerned with the determination of alternative courses of action. Determination of alternative courses of action for the future. So a plan is focusing at a future date that you are planning to be able to do, to maybe create a branch. You are planning to be able to create a unit, a section. You are planning to offer a particular service. You are planning to do a vaccination. You are planning to do voter registration, for example, at a future date. So that's where in public administration the term planning comes in. And when it comes to O stands for organizing. And by the word organizing, this one refers to the process of grouping related activities and creating a hierarchy within a given organization. So this one is concerned with establishing a hierarchy and grouping related activities for performance. So if you have an organization and this organization is looking at creating an industry, is looking at maybe starting a dam, creating an irrigation, for example, scheme, then you may want to organize and see you require engineers, you require technical staff, you require general staff, manual workers. So you create an organizational structure, and within this particular organizational structure, you create a hierarchy which has various steps, various sections, various departments. So you group them, and that is one way of ensuring that once you have now grouped them that way, you can now be able to move to the next step, which is now staffing. You have created an organizational structure, and now you require to get the staff or the human resources to be able to be deployed in that particular hierarchy or in that particular organization. So staffing is the process of identifying suitable personnel, selecting them, and appointing. And once they have been appointed, they are deployed and utilized to perform tasks. So that is the process of staffing. So you identify the individuals, you select them, you appoint them, you deploy them, and then you make use of them, and you also maintain them. So that stands for the S. Then after the S, you have the D, which is now directing. So this is the process of providing instructions for tasks to be performed. So you are now directing and giving instructions for tasks to be performed based on the institutional or organizational requirements. So this stands for the D. Then you have the CEO, which is coordinating. Coordinating. So this is ensuring that things or activities are being done or implemented as expected. Coordinating, liaising with one department with another department, ensuring that facilities, equipments are provided, and so on. Then you have R, which is reporting. So this is where the executive or officer provides feedback or information to a superior. So this is providing feedback that this was supposed to be done, and this is how far this has gone. And once that reporting is done, appropriate action may be taken. The information may be noted, or an intervention measure may be taken into consideration. Then you have budgeting. Now this is involved with the physical planning, accounting, and accountability. So this post-COB acronym, or this post-COB sum of a word, was given by Luther Gulick, and it summarizes the scope of public administration in relation to planning, organizing, staffing, directing, coordinating, reporting, and budgeting as the scope that captures what an organization does in relation to public administration. So that, Lana, is very clear to capture, so that you can be able to go through this process and observe in working environments in relation to what organizations are doing in terms of public administration. So we may want now to move to the importance of public administration. Importance of public administration. Importance of public administration. We want to look at the importance of public administration in the context of a contemporary society. In the context of a contemporary society, the importance of public administration includes, when we talk about a contemporary society, this is a society which is changing. This is a society which is progressive. This is a society that is dynamic, and this is a society where the citizens of that particular society, or the people who live in that particular society, are focused in making their lives better and making changes and using the resources they have prudently as per the principles of public administration. So one of the reasons why public administration is important in a contemporary society is that public administration preserves preservation of the polity. One, preservation of the polity. And when we talk about polity here, we are referring to a set of rules or the constitution. Like in a country like Kenya, we have a constitution and we have instruments that govern the state. And when it comes to the public administration, it aspires to be able to preserve the set of rules that are expected to govern the Kenyans in that context. Then secondly, public administration helps in the maintenance of stability and order. Maintenance of stability and order. We saw when we were looking at the definition of public administration, according to Woodrow requires that an organization observes the rule of law. And if an organization is observing the rule of law, part of what it does is to ensure that the judiciary, the executive, and the legislature are working and order is maintained and stability in a given environment or a given country. Then the next thing that public administration does is institutionalization of socio-economic change. Institutionalization of socio-economic change. An organization, a country is looking forward to ensuring that there are structures that can be able to ensure the society, the economic conditions in that particular society or country is good, and it's maintained to ensure that individuals are operating in a society where you have institutions that stand for particular socio-economic issues that ensure a good quality of life. Then when it comes to the importance of public administration in a contemporary society, it also helps in the management of large-scale commercial services. Management of large-scale commercial services or enterprises. Like if you are having, for example, railway networks, road network systems, or you are talking about harbors or ports which require large-scale economic investments, then the public administration processes now manage those ports, manage airports, manage hospitals at the referral level, provide services like power, among others. So those are some of the things where the areas where public administration becomes important to manage large-scale commercial services or enterprises to ensure that they are readily available, especially where the commercial or private sector organizations may not be able to manage those particular kind of entities. Then ensuring growth and economic development, ensuring growth and economic development. So the public administration also looks at the micro and macro economic activities to ensure that an organization or a country grows and it attains economic development to guarantee the individuals in that particular economy and its neighbors a good standard of living. Then there is also the aspect of protection of the weaker sections of society. Protection of the weaker sections of society. You have, for example, heard in the Kenyan context where you are talking about vulnerable members of the society. Vulnerable members of society. And in these vulnerable members, you have seen, for example, widows, you have seen, for example, orphans, you have seen, for example, the aged. So an organization, a country, through its public administration, is able to come up with intervention measures to ensure that the vulnerable or weaker members of the society are protected for the survival of the society. Then there is also the element of formulation of public opinion. Formulation of public opinion. So the public administration processes help in the formulation of public opinion. For example, many countries are going through this pandemic that has hit the whole globe, COVID-19. So the public administrators are expected to create and formulate a public opinion in terms of how this pandemic can be handled, in terms of how even with this downturn of economic events, how the country can still move on within those particular arrangements and so on. Then the public administration also helps in influencing public policies and political trends. Influencing public policies, policy and political trends. So public administration also is useful in influencing public policy and political trends that a country could be going through. So dear learner, we have looked at the importance of public administration. We have also looked at the scope of public administration, and we have also looked at the office administrative processes, where we have indicated that administrative processes are those office tasks that are required to keep an organization operating. And we have looked at the generic administrative processes or functions of public administration, where we have listed the 6: 1, public policy making; 2, organizing; 3, financing; 4, personnel provision and utilization; 5, determination of work processes, procedures; and then 6, controlling. Those ones are the generic public administration functions or processes. Then we have looked at the scope of public administration in the context of the summary word or acronym POSTCOB that was given by Luther Gulick, where we have seen that this scope of public administration comprises of planning, which is the determination of alternative courses of action for the future; then organizing, which is the establishing of a hierarchy and grouping related activities for performance; then staffing, which is the process of identifying suitable personnel, selecting them and appointing them, deploying them and utilizing them to perform tasks; then directing, which is the provision of instructions for tasks to be performed; then coordinating, which is ensuring that things or activities are being done or implemented as expected; then reporting. This is where the executive or officer provides feedback or information to a superior; then budgeting, which is associated with the physical planning, accounting and accountability. Then we looked at the importance of public administration, and we have indicated that in a progressive or in a contemporary country, public administration is important because of: 1, preservation of the polity, which is a set of rules or the constitution of a given country; 2, maintenance of stability and order; 3, institutionalization of socio-economic change; then 4, management of large-scale commercial services or enterprise.